Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 358th VideoCast podcast for the week ending August 26, 2026. I'm recording this on Wednesday morning before I hop on a flight to San Francisco for the Money Show and to meet some friends up there as well. We will have this part done, and then we're going to insert the Money Show sessions that I'm speaking in and get this out to you. You're probably receiving this late on Thursday night. But as always, family first. We don't have any great family stuff this week because the girls have just gone back to school. They love their, each are starting new respective schools. They love it, making great friends, having fun, and their seasons start. You'll start to see more of the games. We'll have more to share. More of the meets. We'll have more to share. So all I got for you is hosted some friends up at the club to play this week. There's Damian, Chris, Ryan. We had a great time, and so on. So that's the story. Also had the privilege to join Ash Webster on Fox Business. Thanks to Maggie Edwards and Nick Palazzo for having me on. We're going to listen in here.
Let's check the futures, all looking very positive ahead of the opening bell in about 25 minutes from now. Thomas Hayes joins the show. Thomas, look, we have NVIDIA earnings tomorrow after the bell. We have the PCE report, the inflation report. We have Kevin Walsh, the Fed chair, giving a speech on Friday. I would think the market would be doing more treading water, but it seems pretty positive, a lot more buying than selling. What do you make of that?
Ash, I think we're in an environment, yes, we have NVIDIA earnings, yes, we have Warsh, but I think we need to step back and look at the big picture. People are still very enthusiastic about AI the first few weeks of August, and I think when it comes to AI, Ash, you don't want to confuse a great theme with a great entry point. This violent bounce that we've gotten off the July lows, many funds are using that to get liquidity while retail is racing back into semiconductors and to memory. As a matter of fact, Citadel, who bought that $15 billion portfolio from Situational Awareness, it's been reported they've already de-risked 80% of that portfolio. So going into the fall of this year in a midterm election year, pre-election months, there tends to be volatility, and you want to use any strength in coming days or in the coming weeks to get defensive. Trim some of the winners and get into more defensive stocks, Ash.
Well, let me ask about that, because you just highlighted, you called the semis and memory the most crowded trade. So where would you put your money right now? What are you liking?
I think the opportunity and what tends to happen in midterm election years, and we've already seen it starting in July and earlier this year, is that healthcare and staples, defensive stocks, tend to outperform. And I think the most volatile part of the midterm election year is late August, early full month of September and early October. That's when volatility picks up. That's when those healthcare stocks and defensive stocks are going to help you. As a matter of fact, the relative price performance of healthcare and staples relative to the S&P 500 is the lowest since the year 2000, the last tech boom top. So it's a generational buy opportunity and a place to hide out for the next few months. I think you'll find better prices to buy the AI theme, but in the meantime, you can make some money there and you can collect some dividends while you wait.
Very quickly, I got 20 seconds, Thomas. Moderna and Merck reported breakthrough skin cancer vaccine results. So why do you like Pfizer?
Yeah, I think number one, we know that Pfizer has that mRNA technology that they did with Moderna during COVID. So that's a very positive call option on the future. Second, in terms of defensives, you're going to get paid a 6.3% dividend while you wait. They've paid out this dividend for 86 consecutive years. For the last 16 years, they've actually increased the dividend, and you can buy it for 9 times forward earnings, which is a very, very attractive price in this market.
Very interactive indeed. All right, Thomas Hayes, thank you as always, Thomas. Great stuff. Appreciate your time. All right, I want to get now to...
And we're back. And then I had the privilege to talk for 3 panels, or I have the privilege to talk for 3 panels tomorrow at the Money Show, but you're hearing it now because you're getting this Thursday night. So we're going to listen in here.
Let's go ahead and get this thing started. We've got Tom Hayes, founder, chairman, and managing member of Great Hill Capital joining us. Great Hill Capital is a New York-based long-short equity investment fund. Tom is formerly with Cornwall Capital, the hedge fund featured in this movie you may have seen called Big Short. He brings deep equity experience, equity investing, and market strategy. He also is a widely followed market commentator. You've seen him on Fox Business and other networks. If you don't follow his hedge fund tips website or sign up for some of the information you get there, I strongly encourage you to do so. It's fantastic information. He's going to share his views on his turnaround. Tom, please welcome Tom to the stage.
Okay. Good morning, everybody. Did you have a good first day yesterday? Okay, so we're going to spend the next 30 minutes talking about NVIDIA. That's kind of a joke, those of you who know me well. But it's kind of interesting to see the results that NVIDIA put out, and then to look at the semiconductor complex this morning. I was talking with the gentleman back there. A number of the names are down outside of NVIDIA. Mag 7 is down. And the most important thing that's down, which you wouldn't expect based on the guidance that they gave last night, is memory is down. Micron is down, SanDisk is down. So we want to kind of give you an opportunity to have other exposure in your portfolio in this midterm election year, moving into the election period, and how we think about that. So we're going to talk about 3 different plays, just by way of background here. Mike covered most of it. My first boss was friends with Buffett for 40 years, so I learned value investing there. We'd go out to Omaha every year. Then Cornwall Capital, how many of you saw The Big Short? Learned derivatives there. And then Great Hill Capital is my firm, so we're kind of a concentrated equity manager. We do turnarounds. My nickname has become Turnaround Tom. We like to buy high-quality, predictable businesses when they're out of favor, and we look for doubles or triples over 3 to 5 years. Not 100-baggers. I know this is an AI conference, and everyone's looking for the next 100-bagger, but we just like to compound money, and like Charlie Munger said, the number one thing to avoid is unnecessary interruption of compounding. And sometimes when you go for the 100-baggers, you wind up with the goose eggs, and that kind of impairs your ability to aggressively grow your capital over time. So it's okay to have a fun bucket and to go for the shoot the lights out type of stocks, but if you want to build wealth over time, we enjoy predictability and so on. So you may have seen me on Fox and some of the other stations. We also have a weekly podcast called Hedge Fund Tips with Tom Hayes. You can find it on YouTube, and we take Ask Me Anything questions from the audience, and we go through a couple portfolio holdings in detail every single week: balance sheet, income statement, cash flow statement, so you can really benefit from our ideas without any cost to you. The guiding principle that guides everything we do is from the GOAT himself, Warren Buffett. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock price to be misappraised, okay? So we're really looking for those divergences between, like, let's take free cash flow, okay, in predictable companies. Over time, it kind of goes like this, okay? Startups, you have no idea, but predictable businesses go like this, and price oscillates through cycles like this. So our whole framework and where we get alpha is we're looking to buy those predictable fundamentals when they're dislocated temporarily in price. And that's how you can make doubles and triples over time, because you don't have to worry about guessing the future like you have to guess. This is an AI conference. In the late 90s, there was this big debate, who was going to win search? So you had Yahoo, you had Ask Jeeves. Who remembers Ask Jeeves? Lycos, Netscape, the whole thing. Well, guess what? The entire tech trade blew up. And then a few years later, in 2004, this little company called Google, maybe you've heard of it, okay, came out, went public, changed the whole world, dominated search. All the others were left for dead. And I want to offer to you today, and I'm going off slide here, that the best AI trade for the next 5+ years may be something that doesn't even exist yet. Because if you were to survey this room right now, 90% of you would say, or 50% of you would say, or 33 would say Anthropic, 33 would say OpenAI, 33 would say NVIDIA. And I would ascribe that the biggest money is not going to be paid by the people footing the bill. The biggest money is going to be made by the people applying the technology in their businesses. It's not a mistake that Jeff Bezos was out a few months ago to raise $100 billion, not to fund AI startups, but to buy industrial and manufacturing businesses that were going to apply AI to their businesses and double their margins. Okay, so there's a lot of different derivative ways to play the business. Now, midterm years. 4 years, so this is a word of caution. While you're popping the champagne from NVIDIA earnings, I want to bring you back down to earth here and just alert you to some probabilities, not guarantees, but probabilities. Midterm years is election years is what we're in right now. It is the weakest year of the 4 years of the presidential cycle. And you can see this kind of overlay. This is a composite going back 50 or plus years, where you start to see market peaks out in late August. You tend to get some volatility and equity weakness in September, late August, September, and early October, where you bottom out before the election, and then you get a year-end rally. So a lot of people are getting excited, chasing up, popping the champagne corks. I would just advise you that the odds are against you in the next couple of months, that maybe you want to keep a little bit of powder dry and you'll have better opportunities to buy things before the election. Here is the average return of the presidential election, 7%, so we're already ahead of that. I'm sorry, 3.3% is the midterm election and year 2 of the presidential cycle. The median is 0.6%, so we're well ahead of that. Don't be surprised if there's a little bit of clawback on where we are relative to the averages for this time in the cycle in the next couple of months. Here's another way to look at it. This is 4 cycles from Ned Davis Research. That peak that you're seeing right now, that gold line is right about at that peak. This is a couple weeks old. And then you see historically into the election, you get pretty abrupt repricing before the year-end rally. So you could either fall asleep, go on vacation for the next 2 months, wake up in December, nothing happened, or you could build up some cash and be ready to pounce if opportunities happen to present themselves in the next couple of months. There's no guarantee. These are just statistical advantages, but they don't always play out. It's an average over time. You can see it also from Hirsch, the Stock Traders Almanac, and it goes by indices, with the NASDAQ being among the worst hit in the next 60 days. Realized volatility climbs into election day. So you have kind of limited volatility. In August, it picks up. September, it picks up. October is when it peaks. So you get the greatest volatility in a midterm election year in indices in October. Midterm years see the largest intra-year pullback. So on average, midterm election years get a 17.5% pullback. Now, a lot of sell-side strategists have been saying that's correct, but we already had it with the Iran war. We had a double-digit correction. It was pulled forward into Q1 or Q2 whenever we had the full drawdown. And that may in fact be true, but again, I would advise some prudence. You don't know what you don't know going into these periods. One thing is clear. There's always going to be uncertainty into election. If you look at the odds are Democrats take the House, Republicans have the Senate, you have a balanced government, which regardless of what political spectrum you're on, that tends to be good for stock markets when there's checks and balances, just the statistical data. So that's that. Now, the shut index. What is shut? Staples, healthcare, utilities, telecom. Does that sound like go-go AI stocks? No, that sounds like the antithesis of go-go AI stocks, which is defensive stocks. This is where people hide when volatility picks up. And what you can see here is in the period right before the election, in midterm election years, this red arrow up shows that these are the type of things that do best in the couple of months going into the election because volatility picks up and people get healthcare exposure. If you look at the index, you have not seen this type of price underperformance relative to the S&P 500 since the tech peak in 2000. Meaning, when markets are frothy, what's the last thing anyone wants to buy? Are conservative, defensive stocks. And Kim remembers in 2000, there were articles on all the major publications, whether it was Forbes, whether it was Barron's. Has Warren Buffett lost his touch? Because everyone was chasing what? The internet build out, the internet boom, et cetera. And Warren Buffett was underperforming for 2+ years. He was buying Coca-Cola, he was buying Procter & Gamble, he was buying Disney, and everyone else was buying what? Fugazi eyeballs, okay? Now, I'm from New Jersey. Everyone knows what Fugazi means. San Francisco, maybe not so much. So you can see, when he was aggressively buying those, no one wanted them. You look at that spike down in 2000, we're even more pronounced people not wanting defensives, which tells you be a little bit fearful and cautious when others are greedy. And that's why you see the staples in healthcare outperform in these type of periods when people can't get enough of the shiny objects, chasing what's hot, what's in the news every single day, popping champagne corks right before the Titanic goes down. Not saying that's going to happen, but okay. Now, also in the midterm election year, and this is buttressed by this period in coming months where volatility picks up, healthcare tends to dramatically outperform. Now, the XLV is already up double digits year to date. The average return is 9.03%, relative to the S&P, which is 0.62% in a midterm year. So we're seeing that. We saw it aggressively in when? In July, when semiconductors sold off between 30 and 60%, depending on the names. We got the dead cat bounce and short covering bounce in August. We're seeing a renewed weakness in much of the semiconductor complex, sans, NVIDIA. We're seeing continued weakness in some of the memory, and this could just be a breather. I will say one thing. I've done a lot of research on the railroad build-out from 1867 to 1873, the tech telecom build-out. I would say if we do get short-term weakness in the next 2 to 12 months in the AI trade and people get pessimistic on the AI trade, it's likely a buy opportunity. I do think we're mid-innings because if you look at the railroad build-out, it lasted 5 to 6 years of the boom, and CapEx got to 5% of GDP during that period. The internet telecom build-out from 1995 to 2000 lasted 5 years, the run-up. The CapEx as a percentage of GDP was 5%. Right now, we're at about 3.7 years into the AI build-out. Okay, so seems like on average we have a little more time to go, and we're only at about 2 to 3% of CapEx build-out, okay, of GDP. So it seems to me that you should keep in mind also, though, from 1995 to 2000, even though the theme was straight up, the semiconductor complex corrected 50% or more 3 times between 1995 and 2000. Most people forget that. When they look back, they think, oh, it just went straight up for 5 years. There will be washouts along the way, but I think don't mistake the most attractive theme for the most attractive entry point. Right now, everyone is super excited about AI. You all came and got on a plane to go to an AI conference. Tells you everything you need to know. And I think your instinct is correct. Over the next 5 years, a tremendous amount of money is going to be made in AI. I think where you enter may impact your overall returns, and I would pick your spots. Wait for a little bit of pessimism to come into the market before you step up and load up. Okay. Healthcare here, you can see going back to 2000, same story. one of the generational. It's the lowest relative performance in 25 years. These are times when fortunes are made, when you're buying things that no one wants, they're out of favor, that have predictable businesses, predictable cash flows, compressed multiples because of lack of interest. Consumer staples, most underweight in years. You can see there. Cyclicals take the lead 6 months after the midterm. So everyone's left the consumer for dead. Restaurants are in the gutter. Consumer discretionary is in the gutter. You saw Dick's. You see Nike. You see some of these other names. These are times to be buyers in coming weeks and into weakness, not to be sellers, okay? Most people sell in the hole. We've made our money buying on weakness and selling on strength. We buy when no one wants it. We sell when liquidity is created and everyone wants it. I would suggest it's a very good way to live and a very predictable way to get alpha over time. Not easy, simple to do, not easy to do. Most people say I have a genetic defect because when God was handing out FOMO genes, he didn't give me one. So everyone's like, NVIDIA, okay, yeah, go have at it, sold to you. But so that's that. So the consumer discretionary as well. I think consumer discretionary, you want to be waiting. Right now, defensives should help you into volatility. Consumer discretionary, you want to buy when things look the bleakest. And in the 6 months coming out of that weakness, post-election tend to be the greatest returns for the indices in the 4-year presidential cycle. So on the one hand, I'm saying caution. On the other hand, I'm saying pick your spots, because as we get through that weakness into the election, if you have some dry powder now and you can buy down, the following 6 months tends to be very, very bullish, historically, statistically. Okay, so lowest allocation to the consumer since 2006. You can't give away a consumer stock. Chipotle's in the gutter. Anything related to restaurants, clothing, consumer spending. And that's an unwise bet to make when the American consumer has a job and unemployment is at 4.3%. Real wages are slowly improving. You want to use these discounts aggressively. Okay, a couple quick picks here, and then we'll open up for questions. Here's our healthcare pick. Dent, Splice, Sirona. By the way, they don't call me Turnaround Tom for nothing. Look at this chart, okay? So we've got an $11.22 basis on this thing. Stock's down 90%. How did they screw it up? It's been around since 1899. The leading company in dental supplies, chairside milling. You go in, they take a picture of your tooth, they put it in the machine, they print the tooth, they put it in your mouth, you go home. It used to be come back in 2 weeks, come back in 2 weeks, come back in 2 weeks. They're a leader, they're an innovator. A lot of sales offshore. So they did a bad deal, bad merger with Hillrom. They bought Byte, the invisible tooth thing in COVID. How many people bought a Byte during COVID or know someone who did? Everyone. They bought the top, they overpaid, they had to write down $1 billion. So a lot of unforced errors. Now, the key thing with turnarounds, with Turnaround Tom, and I'm going to talk about our entire framework in the breakout session this afternoon. Mike's going to tell you what time. It's around 12 o'clock. 45-minute session. You never want to hire the arsonist to put out the fire. So one of the key things with our turnarounds is we want a good jockey. And they brought in Dan Scavia within the last year. He ran Globus Medical for 10 years, chief commercial officer, chief executive officer. That stock was a 4-bagger. He's come in, costs have been cut. He actually started buying back stock in the most recent quarter. He reestablished distribution agreements with Patterson, with Shine, with all the major dental suppliers. The previous management had this brilliant idea like Nike did, oh, we'll just screw all of our wholesalers and we'll go direct to consumers. We've had these relationships for decades. Well, you can see what that did to the stock. So Dan Scavia said, no, back to basics, reestablished all the distribution. Those are ramping up. This, we think, can be a multi-bagger over the next 3 to 5 years. We love this stock. Second one, Diageo. Who thought they were going to come to an AI conference and hear about alcohol stocks? Well, this is where you hide when volatility picks up. And what we love is we love free cash flow. So they loaded the channel during COVID when people were paid to sit home and drink. Not a good thing. Stock fell 50%. Leader in spirits, Johnny Walker, Casamigos, Don Julio, Smirnoff, et cetera, et cetera. Stable business. Cash flow is growing, but they overstocked, and now they had to destock, And Dave Lewis, who they call Drastic Dave, he turned around Tesco. He was at Unilever for many years. He's come in, he's taken a tremendous amount of cost out of the business. Every region is growing double digits around the world. Guinness is growing like crazy. Guinness Zero, which is non-alcoholic, is growing 40%, by the way. The only area that's in trouble is the United States. And the United States has a tequila problem. And there's a Kenny Chesney song, I think tequila makes her clothes fall off. Well, in the case of Diageo, tequila makes her earnings fall off. But they're fixing that problem. The rest of the world is growing. US is struggling. He's cut the cost. They're going to do, by the way, this company is trading, if you look back at the chart, it's trading like it's going out of business. They're doing $3.2 billion a year of free cash flow. You think they're going to figure this out? You bet. By the way, everyone's like, well, people are on GLPs, no one's ever going to drink alcohol again. 85% of people who start GLPs are off within 2 years, and the impact on alcohol consumption, if you look at the statistics of the people who are consistently on it, it's a reduction of about 2%. Doesn't warrant a 50% drop in the stock, and that's where your opportunity is if you're a little bit of patience. Again, this is not going to be a 100-bagger, but doubles or triples with some predictability. And the other thing I learned in the business over the many years that I've been doing it, if your downside is protected, AKA you have a solid balance sheet, you have free cash flow, the upside will take care of itself over time. Then it's just a time arbitrage play. You don't have to guess the future. You don't have to guess who's going to win the search race. You don't have to guess who's going to win the AI race. You don't have to guess who's going to cure cancer. All you have to do is look at that baby cash flow, know that you're buying the stock down 50%, and wait for the recovery because you've got a good jockey in place. Okay. Final one, VF Corp. Remember I said you can't give the consumer away? Well, this is trading like what? It's kind of trading like Nike. The difference is you have multiple outs with VF Corp. VF Corp has a suite of brands. They have been trading in and out of consumer brands for over 100 years. Note the theme here. I like things that have been around for a long time, that have survived through depressions, through recessions, through wars, etc., and stayed in business, and buying them when they're dramatically out of favor, because that happens every cycle or so. So, what do they've got? First off, the most important part of this story is Bracken Darrell. Okay, I had him on my podcast. I call him Growth Bracken. He came from Logitech. Logitech makes the mice and the cameras. When he joined Logitech as CEO in 2013, the stock was also down 86%. He came in, applied his playbook from Procter & Gamble, from a few other companies that he had been with before Logitech. If you had put $1 million in Logitech when he became CEO with the stock down 86%, you made $26 million over the next 7 to 10 years on that investment. Now, Logitech is a commodity provider. They are not curing cancer. They are not winning the AI revolution. It's execution, discipline, margin expansion, cost cutting, a little bit of luck with some product rollouts, and he's doing the exact same playbook at VF Corp with now Timberland, North Face, Vans, Ultra, JanSport. If you had kids go back to school this week, JanSport, Eastpak, they own all of those brands. So first thing he did is he came out, he cleaned up the balance sheet, sold off Supreme, sold off Dickies, delevered, takes existential risk off the table, takes solvency risk off the table, so he has the runway to run the turnaround plan for his shareholders like Turnaround Tom and his clients, and that's exactly what he's doing. So you've got a great opportunity while consumer discretionary is out of favor in the Wall Street fashion show. It will come back in favor when? Probably right after the election, and you want to have exposure to these type of stocks. You can see the biggest weight. North Face is hitting on all cylinders. Timberland is hitting on all cylinders. Ultra is growing like a weed. JanSport and Eastpak are doing fine. Vans International is doing okay. Vans US has a problem. That's the big problem. Sales have dropped meaningfully from the 2022 highs. It is now turning the corner. 70% of the portfolio is back to growth, And Van's issue in the US was the wholesale channel. Their DTC, direct to consumer, grew mid-single digits last quarter for the first time. It is inflecting, and that's going to be hugely accretive to the bottom line. So we love this story for a multi-bagger over the next few years, and Bet on Bracken is the name of the game. That's how you can reach us. That's our podcast. And if we have time for any questions, I'm happy to take a couple. Okay. Yeah. Okay.
In your opinion, where do you see the S&P 500 finishing at the end of the year?
You're asking me a question on both price and time?
Yes.
Yeah, that's the worst question that you could ever ask someone. I could tell you price over time, I could tell you time. I can't tell you both. That's not a way that we make money. So the way we make money is what we call private equity in public markets, meaning we underwrite each investment as if we were going to buy the whole company. And if we wouldn't buy 100% of our company with 100% of our net worth, we won't even buy one share. Now, if you want to play games and say like, oh, I want to guess on Kalshi, like is the market going up or down? From here, I think it's down then up and probably net neutral over the next 6 months. That's a guess, but I wouldn't use that to try like as a way to make money because it's just an opinion, finger in the air, like hope.
Okay, I should clarify a little bit.
Yeah.
We all come for different reasons. One of the reasons I come here is for investing for my grandkids.
Yes.
So they have earned income, and I have them in the Roth IRA.
Yes.
So I'd like to know if you, in your opinion, like what are the cornerstones that I have in as the S&P 500?
Yes.
Is it a good time to put more money into the S&P 500 before the end of the year?
Yeah.
Or do you see it better next year?
Oh, okay, yeah. What I would be doing in that case, and this is opinion, not advice, because I'm not your financial advisor, is I would be dollar cost averaging. So if you have $10,000 you're going to put in $2,000 over the next 5 months because you're going to average out, and as the market rises over time, you're going to be fine. So rather than time it perfectly, dollar cost average, you'll get better returns over time, and you don't have to think about it and make it automatic. Yeah. Hey, how you doing?
You take some very good calls from people gathered, like Intel was a phenomenal pick. Maybe sort of too soon that you think it maybe buy it back eventually if it goes back down again. But you mentioned you don't have the FOMO gene.
Yeah.
But you probably have a gene that says you stay the course.
Yeah.
And it's probably sometimes difficult to stay the course when you have a stock and you're convinced this is it, but it keeps on going down. Maybe you buy more, maybe you average it out.
Yeah.
But how do you convince people, ordinary investor, to stay the course in the stock mix?
Yeah, that's a fantastic question, and thank you for the compliment. The number one thing, Thoreau said, know thyself. I say, know what you own, okay? If you understand the fundamentals and you're underwriting, and by the way, all of you know how to do this. You think that because it's a public company and it has a daily quote mark to market, that it's something special. If I were to tell you, you're going to go out and buy a Jersey Mike's franchise tomorrow, you would know how to do financial analysis. You would go to the owner and you'd say, how much did you sell last year? And he'd say $1 million. Okay, how much did you make after paying all your expenses? He goes, I don't know, $150,000. And you say, okay, $150,000 of earnings to my pocket, I got it. How much do you want for it? And he goes, I want 100 times sales, $100 million. And you say, get the hell out of here. And yet, in public markets, you guys do that all day long. You can't get enough at 100 times sales. You would never do that in the private markets. And I think if you apply that type of common sense, as it relates to you buy something based on an assessment of intrinsic value over the long term, and it goes against you, if you have additional capital, buy more, you bring your basis down. But the thing that I like to say on the podcast, they don't give away multi-baggers for free. Okay? You're not going to pick the exact bottom. You're not going to get the exact top. But if your framework and analysis is consistent, predictable, and you don't deviate, you're going to make money, and consistent money and alpha over time. Where people get tripped up is when they have style drift and they keep chasing the next big thing and they never get any traction with a predictable, repeatable method.
We do one more, and as a reminder, everyone, Tom will be.
I have one too.
Yeah, okay.
Well, she definitely gets
Okay.
And then we'll be in the, Tom, during the coffee break, we'll be doing a meet and greet right over here. So you'll have a chance to ask any questions if you don't get an opportunity here during that break. So just to let everybody know.
And I also want to know, when is his workshop?
Workshop is at 11:55 in the Empire Room today.
Fantastic.
Great, thanks. 11:55 Empire Room. Write it down. Tattoo. Go ahead. Thank you.
Microphone one.
Check.
These are all my plants, by the way. John flew in from South Carolina. I paid for his ticket. Go ahead, John.
I am a big fan of Tom. I follow his podcast, a lot of stocks that he owns. Do you ever foresee being like a Buffett? Because I know you're a Buffett disciple, like I am, holding stocks for long periods of time.
Like forever stocks?
Forever stocks. I
Yeah.
had some of his stocks from when everyone thought he was nuts.
Yeah.
And those returns are nuts.
Yeah, for sure. That's a great question. You know, I've developed my own style over time, so we're more interested in doing what he did in his partnership days when he had his highest returns, where he was doing a lot more workouts and a lot more turnarounds, and the holding period was, like normal, like what we're doing on average of 3 years, because he needed doubles and triples, because he needed to produce returns for the people he worked for, which is his clients, which is what I need to do. Now, in your PA, if you're buying, if Coca-Cola gets dislocated, or by the way, I remember earlier this year I was talking to a group of wealthy entrepreneurs. The average net worth was 100 million, and they were asking me, should I be in cash? I was like, well, you could do that, but dividend-paying defensive stocks, like the stuff that Buffett buys when the market's frothy, are trading at 25-year lows. Why wouldn't you just buy a basket of 7 of these? The average yield is 7%. Most of them have grown the dividend every single year for the past 40 years. And everyone who did that, their portfolios are up 30, 40%. They've got income coming in. So the answer to your question is, for a personal account, yes. For generating alpha as a professional, I think, when something's up 3x, you got to ring the register, because over 20 years, you're going to have 50% drawdowns in that name every 3, 4, 5 years. That's just normal. So you got to lock in some of the gains. So I think from your perspective as an individual, if you're buying good quality, durable businesses at dislocated price, you can probably hold it till the day you die. As far as generating returns on an annual basis and delivering for your clients, I think you got to lock in profits when they give you a lot pretty quickly. Yeah.
I have a question.
Yeah.
Hello, I have a question. First of all, I want to tell the audience, because several of you were at other events this morning, that Tom Hayes has got to be one of my favorite, absolutely favorite hedge fund managers in the business. He buys with conviction, and he is an amazing. I think you're a quant. Aren't you a quant?
No, I'm a value investor. I mean, we're looking at, we burden ourselves with the facts and math and data. So in that regard, yes. But the implication of a quant is that they're kind of in and out on price movements. We're kind of the antithesis. We're trying to underwrite the whole business.
And what I want to say is that right now the Fed is having a meeting in Jackson Hole.
Yeah.
I've been listening to a lot of things this morning very early.
Yeah.
And obviously we're seeing the potential of interest rates rise for
Yeah.
several of the board members. If interest rates rise,
Yeah.
what is your advice?
Yeah. If interest rates rise, my base case is that it would be temporary, and I wouldn't really impair. Look, during the 90s boom, the 10-year hovered around 5%. So, we're at 4.6 and change. It's not necessarily the absolute number, Kim. It's the rate of change that could be really, really damaging. I think if rates hovered up toward and around 5 like they did during the late 90s, we've got a lot of good things happening in the underlying economy, and it'd probably be okay. If they went to 6 in 2 weeks because he said something crazy at Jackson Hole, that would be problematic. And probably temporary. I think if you actually think about the application of AI into industry over time, margin expansion, et cetera, it's going to have a probably net neutral or net deflationary impact on prices over time and prosperity over time. So I wouldn't make the case. I know people are worried that rates have come up a lot. I wouldn't make the case that we're headed into a long-term bear market in bonds. I would actually probably take the other side of that, and over a 12-month period. Right now you have the largest net short in Treasury notes that you've had since 2022, which was right before a rip your face off rally in bonds, compression of yield. So I'd be taking the other side of that with a 12 to 18 month view, a buyer on the center of the curve versus a seller. Yeah, my pleasure. Thank you. Thanks everyone. We tend to avoid gold producers. We've just found that over the years, first off, you have to get two bets right. So you got to get the underlying commodity right, and then you have to get management execution right. A lot easier to get the commodity right than it is to get underlying management execution right, because for a lot of them, they have this uncanny ability, no matter how high the price of gold or silver goes, they figure out a way to lose money. So you could get a price move on a cyclical basis, and some people are really good at that and can make a lot of money doing that. We try to avoid it. We did have a miner, which kind of goes against our framework, but it just got too cheap, which was the lowest cost lithium producer in the world, called Albemarle. It got down to $59 a couple of years ago, and we thought it was going to take 3 to 5 years to be a double. It was a triple in a year, and we got out, but that's come back down. We might revisit that one.
Pharma space that interests you, or one of the sort of companies that sell into or support the pharma industry?
Yeah, actually, we like Pfizer. We think that the stock's down quite a bit from the COVID highs, the loss of exclusivity issues, but they've taken a ton of cost out of the business. They've got the oncology franchise with Seagen, which they got at a reasonable price. They have a once monthly GLP on the back burner, which would help a lot of people, so you don't have to inject 4 times a month. And I think that there's also a pill version of that that's in the pipeline as well. So there are a lot of ways to make money on Pfizer. You collect a 6% dividend yield while you wait. You have 7 to 9 times forward earnings, depending how far out you look, and your downside's protected. And that's kind of the things that we look for, a way to get paid while you wait, and then you get some of these catalysts that can drive up the price over time.
Questions for Jason there. If semiconductor market goes down similar way as from ET, because this also will be inflation. So what do you think that interest rate increase can do to the market? And for Jason, is it going to be a good opportunity for buying those stocks?
Well, first and foremost, I mean, if you look through history, new Fed chairs tend to get tested in their first 6 to 12 months pretty aggressively by a correction in the market. He hasn't been tested yet. We'll see what comes out of Jackson Hole. We'll see what happens going into seasonal weakness. I think your basic premise, first and foremost, you're going to make big money over time, not timing the market, actually underwriting individual businesses. But I think there'll be better spots, and that was kind of the thesis I wanted to give out this morning, is don't confuse a great theme for a great entry point. And I think there'll be better entry points to get involved. But I would also stay on the AI beneficiaries versus the AI cost centers. We've got a little natural gas company called Comstock Resources. Jerry Jones owns 71% of the stock. They're trading at about a $4 billion market cap. They've got 3 times that in proved and unproved reserves. They're based 100 miles from Dallas and Houston and the Gulf, perfectly located for data centers. Data center growth, 160% by 2030, according to Goldman Sachs. Natural gas is going to power 60% of that. They're the lowest cost producer in America. So I'd rather play the non-obvious trades are the ones. So, several years ago, Intel and Micron were the non-obvious trades. They went parabolic. We had Intel, not Micron. I think prospectively, natural gas is totally not focused on right now. The supply-demand issue is going to be severe imbalance in terms of powering all of this infrastructure and growth. And then some of the beneficiaries like GXO Logistics we own, that's a Brad Jacobs company spun out of XPO. They've got 20,000 robots already picking, and they've got AI in all their warehouses. Their margins are increasing already from the implementation. That's been his playbook since his United Rental days, since his XPO days, but now the technology's gotten better, so margins are gonna go up. Logistics, reverse logistics. Look where people aren't looking, what's out of favor, that's gonna benefit from the AI theme versus chasing what's obvious and already had their moves. You are seeing me for the first time today. Never heard of Tom Hayes. Oh, wow. All right, great. Well, thank you. Very excited to have you.
You've never been at the Vegas show, ever?
I don't think I've been to the Vegas, maybe one time in Vegas.
Which one do you normally go to?
I do Sarasota from time to time, but now this is closer to me. Maybe I'll start doing Vegas because I can jump on a quick flight to Vegas now. But I'm glad to be here. How many of you have ever listened to one of my podcasts? 1, 2. Okay, cool. So we've got some fans from the podcast. How many of you are not podcast listeners, but have seen me on TV once before? And that's why they came. Okay.
This morning.
Okay. All right. Great. Welcome. Thank you for coming. So the name of this presentation is the Turnaround Tom Playbook. And what I'm going to share with you is kind of what I've learned through the decades of doing this, how you can get kind of predictable performance over time by buying pretty predictable, durable companies when they're completely out of favor. So, AKA the antithesis of everything you've learned this week. So welcome. So let's get to it here. I'll just go through a little bit of my background, and then we're going to cover some case studies that we've done over time. And then we'll leave you with some current positions that you might find interesting. So as you heard this morning, kind of started with, my first boss was friends with Warren Buffett for 40 years, so I kind of cut my teeth in the value mafia in New York City, going to hedge fund lunches with Lee Cooperman and Mario Gabelli and that ilk. And he also set up the Warren Buffett Principles of Investing course at his alma mater. So we would take 30 students every year to Omaha and meet the wizard. And so that was a great experience. And then I went on to work with a company called Cornwall Capital Management. Many of you know from The Big Short. In between then, one of our holdings was a public company at Bedford Oak, which I was appointed COO when I was like, could barely find the coffee machine. And my job was to sell off non-core assets in the company and take that cash and go out and buy an asset manager. And what's amazing about, anyone do a business acquisition in the past in their careers at all? Well, what's amazing about doing business acquisitions is you get to look under the kimono. So you say, I want to buy your business, and they show you everything. And what I got to see, I interviewed about 100 different asset managers, and I saw all different strategies, from growth to value to flavor of the month to precious metals. And I saw which strategies were durable over time and were consistent money makers through cycles, and which ones just petered out and weren't durable and were just flash in the pan type of strategies. And that was a tremendous experience. We wound up buying a firm that had a value tilt, by the way, 1.6 billion under management. I paid 1 times revenues, by the way. Got control of that for $6 million, and so on. So, and then I went on to start my own firm, Great Hill Capital. So we went through some of this. I would strongly suggest, and maybe talk with some people who have been long-term listeners of the podcast, every week we go through 1 or 2 of our portfolio positions. We announce new positions, we go through balance sheet, income statement, cash flow statement, and explain the rationale behind our investment and then how it's progressing as they report quarterly earnings, et cetera. So you can find that anywhere you get podcasts, Hedge Fund Tips with Tom Hayes, and on YouTube is the greatest value because we take Ask Me Anything questions from our incredible audience like Sagar, and we go through it. So they'll give us a company and we pull up balance sheet, income statement, cash flow statement, and we say why we would pursue it and do research and possibly do an investment in that, or why we would probably pass on that And people get a lot of value out of that as well. And you can send in your own questions. So maybe we'll do a few at the end. I know Paul has a question over there. Okay, so we run our strategy in separately managed accounts through Interactive Brokers. Our core composition is 8 to 12 concentrated public positions, and then that's 85 to 90% of the portfolio, and then 10 to 15% is our options overlay, which we'll explain. But the key theme, which we touched on this morning, and is basically my guiding light. This is how I make all my decisions. Great Christians say, what would Jesus do? Great investors say, what would Warren do? So great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. And that's something we're going to really dig into here and give you a lot of value in terms of the framework that you can go out and apply to companies that you're looking at on a regular basis. And we do something that's unpopular. I went to a new doctor when we moved to Newport, and he goes, "Oh, what do you do for a living?" I was like, "Oh, do you really want to know, or are you just asking the question?" He's like, "No, I really want to know." I was like, I do pretty much what you do. He goes, what do you mean? I was like, well, about how many people that walk in here want to lose weight? He goes, about 100%. I go, okay, so what do you tell them? Eat less, exercise more. How many do it? No one. So they want a pill. I go, I do the exact same thing. He goes, well, what do you do? I go, I buy low and sell high. I go, everyone knows that's what they should do. How many people do it? No one. So that's that. And then he's like, so he goes, well, tell me more. I was like, well, it's really God's work. I make rich people richer. So that's the story there. So we profit from buying on weakness and selling on strength, driven by deep research and the conviction that the greater the price dislocation actually reduces risk. And we'll talk about that. Where others see volatility as danger, we see it as opportunity. How many people, when they see a stock go down, their first thought is, that's risky, that's not safe, the stock is going down, that's too volatile. That's the common thing because we're wired that way as human beings to follow the herd, and following the herd works most of the time to get follow the herd type of results, which can be fine over time, and you can do that in the S&P and double your money every 8 to 10 years without any effort. But if you're looking for a little bit of outperformance, sometimes you have to step away from the crowd and be willing to take some short-term heat for a long-term reward. And the two key investment filters that we use when we're evaluating a public security are, number one is if JP Morgan was going to finance me to buy the entire business, debt finance it, with one catch, I had to be 100% of the equity with 100% of my net worth. Would I do the deal? And if the answer is no, we will not even buy one share of stock for us or for our clients. So imagine if you had that rigor every time you bought a stock versus, Peter Lynch used to say, people will spend 2 weeks planning their annual family vacation, every deal, every minute, every itinerary to save a few bucks here and there. And then on the train on the way home, they hear a stock tip, they put their entire life savings in it. So beware of that. So having that rigor. And if you operate from that, in this case, the equity slug is small. So if it works out, you make many, many times your money. But if it doesn't work out, JP Morgan gets the business, I'm wiped out, and I got to go apply as a job at Walmart as a greeter. So that's the rigor that we put into every single analysis that we do for every position in the portfolio. The second filter is the dislocation test. If I walked into the board today of the company and offered to buy the entire company at its current price that it was quoted in the market, would they call security to have me escorted out of the building, or would they entertain the offer? And if they would entertain the offer, it's not dislocated enough. So those of you who have been listening to for a while, PayPal is one of our larger largest position in the portfolio. And we brought our basis down to $49 and change in PayPal. And then Stripe and Advent came in with an offer for $60.50. So PayPal's a stock that, dropped, I don't even know what it peaked at in COVID, over $300, down to $38. So the stock was, 49 or something when Stripe made the offer. They offered $60.50. And the board said, that is inadequate. We're not interested. So I know, but I knew the answer to the question before they said the question. Not only was it inadequate where I was able to accumulate for my clients at 49, it was inadequate at $60.50. And my guess is, if they have half a brain, it will be inadequate at anything under $80 because they're generating $6.3 billion of free cash flow per year, and they're back to growth. So we'll talk a little bit about that later on. So these are the two filters before it gets into the portfolio. And I would say Charlie Munger was the best when he said, beware of the temptation to dabble. Okay, we think it's, I often say that the reason many people become wealthy in real estate, maybe more than in equities, is because in real estate, when there's a headline comes across the ticker, you can't sell and you can't get liquidity. So you're forced to get wealthy in spite of yourself because you have to hold the buildings for the long time. Whereas with stocks, people trade in and out of them like they're playing cards. And if you've done the work and you've underwritten it well and you've bought at enough discount to intrinsic value, it's not speculating, it's not guessing, it's just a time arbitrage game. Some take, 1 year to double and triple, some take 5, but on average, if you do your work well, you should get doubles and triples in 3 years across a portfolio of 8 to 12. Okay, so if a stock price is down 80%, a lot of people think that there's existential risk. This could cease to exist. This is very, very risky. They're going out of business. Maybe they're no longer relevant. So the first thing that you need to do when buying a stock that's down a lot in price is solvency risk. Okay, and what we do is we look at the balance sheet. We look at the cash flow. Do they have enough free cash to service the debt with a large margin of safety so they have enough time to run the turnaround plan, to reignite growth, to get things back in play? Oftentimes a stock that's down that much is down for a reason, and they do have financing risk, whether they'll be able to refinance the debt, or even worse, the cardinal sin, issue a ton of equity and make our share of the pie much smaller due to their inept management, effectively, is what it comes down to. So we don't want a situation where either one, they can't roll their debt, or two, or service their debt, most importantly, never mind roll their debt, or two, they dilute us because they have to raise equity at the worst possible time at the lowest price. 2, management. We touched on this morning. You generally don't want to hire the arsonist to put out the fire that they started, okay? You're often looking for a new jockey who has a history of successful turnaround situations. There are exceptions to this. I'm going to share a good one in the case of Cooper Standard, which is an auto parts supplier, but they're the exception, not the rule. Then the third thing, and this is where probably we excel, with a stock price that's down a lot, you have to determine, is this impairment temporary or permanent? Okay, so I'm sure there were a lot of horse and buggy manufacturers around the turn of the 19th century that the stocks were down quite a bit. Okay, but that was a permanent impairment because the automobile was just around the corner. In most cases, it's not a permanent impairment, and being able to distinguish whether the price weakness is an overshoot or actually justified is where you get the alpha. And then finally, and this is critically important, is a catalyst. We don't want to just buy cheap for cheap's sake and get stuck in a value trap that's going to be cheap forever, or cheap for a reason, or because it has a low PE multiple. Some of the best companies, cheapest companies that we've bought have been at 100 times earnings. And people are like, well, how's that possible? Well, it's pretty simple. if a company has been around for many decades and they are on a normalized basis, that's a key word, normalized basis, they earn $2 to $2.50 a share, and all of a sudden it's a cyclical business, you're in a recession, they kitchen sink the quarter, it goes down to 2 cents. Well, 2 cents of earnings. That company that traded at 10 times earnings at $2 of earnings is now trading at 100 times earnings at 2 cents of earnings. But if you look under the hood and you do the work and you say normalized earnings is $2, you're effectively just playing the time arbitrage game till it reverts back to its normal earning power, post-recession or post-cyclical downturn for the industry, et cetera. So catalyst, what's the turnaround? And then the last thing that I would say about how we underwrite investments is think about it as private equity in public markets. So private equity, they're looking to buy the whole entire private company, with their fund. We do the exact same thing when we're entering a public security. We underwrite it as if we're buying the whole company or we won't buy one share. And that's a really good framework to ensure that you're doing the work. The other thing is all of the academic research going back 40 years tells you the same thing. It's not impossible, but the odds are dramatically against you to get any semblance of outperformance if you're managing more than 15 stocks. Okay? So you could be the exception, but I wouldn't play against the odds. And if you're only going to have, in our case, 8 to 12 companies, you better damn well know everything about that company, backward and forward. The other thing is, if you have 100 good ideas and you have them all in one portfolio, even if one doubles or triples, it's not going to move the needle for your performance and for your wealth. So why even bother if it's not going to move the needle at the end of the day? Okay. Portfolio construction and risk management. As I said, 85 to 90% of the portfolio is core equity positions, 8 to 12 high conviction positions. 20% is the max on any one position. That's only happened a couple times in our history. Every position is underwritten with the same depth and rigor as private equity. We target doubles and triples over 3 to 5 year horizon, generating long-term capital gains, rinse and repeat the process across cycles. The 10 to 15% of our bucket is our asymmetric options overlay. So we may have an EV, expected value, expected return on that bucket of individual positions of 7x. Now it's only 10 to 15% of the portfolio, and not all are going to work out. Some could be 10x, some could be zeros, but these are like 1 or 2% of equity each position if you think about 5 to 10 positions. And oftentimes, some of it will be straight premium where we're just long calls on our underlying positions to add excess alpha without drawing major leverage. Oftentimes, there are long-dated call spreads where we can get 5 or 10x on a position as it appreciates over time. And then from time to time, we're doing put spreads or straight puts in that bucket when we think the market is excessively overvalued, but maybe we haven't reached intrinsic value on enough of our positions where we're sitting on cash and we want to dampen the volatility by being kind of short indices or sectors, or in some case, individual companies with a quantified risk. We never have anything open-ended. We're never short a stock. We would express that through quantified either straight premium, straight puts, or put spreads. So that's that. And that can add a tremendous amount of alpha, as it did for us last year. Okay, structural advantage. Our number one structural advantage is time horizon. We're in the time arbitrage game. People often say Tom Hayes must have ice in his veins, nothing bothers him, but it's really doing the underwriting properly and waiting for the thesis to play out. Hi, welcome. So what you can see here in what we like to talk about all the time is in the short term, the market is a voting machine based on emotions. This is from Ben Graham, Warren Buffett's teacher. Whereas in the long term, it's a weighing machine driven by fundamentals. And what that means in English, you can see going back to 1900, this chart over here, there is a 98% price to earnings correlation since 1900. meaning invariably in the long term, price will always catch up or catch down to the underlying earnings power and fundamentals. And where people get shaken out is when the price diverges too much from those earnings, either on the downside when they're selling in the hole when they should be buying, or more commonly, like we're seeing in some pockets of AI, on the upside where everyone's chasing the exact same thing well ahead of the fundamentals, anticipating and extrapolating what's happened in the recent past in perpetuity into the future, and that's where you can get over your skis and eventually get reversion back down. Meanwhile, the average holding period of a stock over this time period, you guys are not going to believe, or maybe you will, it's collapsed from 8 years in the 1950s. People would hold a stock for 8 years. Yeah, now it's just 5.5 months today. Isn't that crazy? How do you expect to make money in 5.5 months? They haven't even found the coffee machine yet. So leaving most positions priced on headlines and sentiment rather than the earnings power, which over time is where it's going to catch up or down to. We underwrite every investment on a 3 to 5 year horizon, buying what the voting machine discounts and holding long enough for the weighing machine to kick in. Okay, that's the secret sauce. I wish it was something sexier, but this is it. You know, eat less, exercise more. I mean, what buy low, sell high. Yeah.
So how is the holding period computed? Is it based on the weighted average of the volume being bought and sold, or how is it computed? I'm curious because is the same trend contributed by institutional buyers also?
Oh, how do they calculate this?
Because if this is across the board, then really there is no concept of long-term hold right now.
Measure by value of stocks divided by turnover. No, that's it. Every stock that's traded in the market.
Every stock.
Correct. Yeah, that's a good question. Go ahead.
Yeah. If you look the left chart,
yes.
The price is now it's go much faster, higher than the earning. So that means the overall price of.
Yeah, and guess what? That's a great point. What's your name?
Yeah.
What's your first name?
You
can say it. I can't read it from here.
Oh yeah, IAN.
Okay, great. Nice to meet you. So, what is the highest composition of this blue line? What is the highest weighting? What's causing this to diverge so much from earnings? What?
I might have under it's concentrated to the high tech.
Yes.
7 or 8 high tech.
That's right. 40% is kind of AI related right now, so it's getting a little bit ahead of itself relative to earnings power. The bulls are betting that this ultimately, all that investment causes this to hockey stick up to here. The bears are betting like, this has been an overshoot for a long time. It's probably going to catch down over time. And the truth is probably somewhere in between, as it is with most things in life. Okay. We're going to, yeah, go ahead.
Quick question. So if you go back to your previous slide.
Yes. Okay.
So the yellow line, the blue line started going down after that double peak, right? It went down a bit.
Yeah.
But then if you see the yellow line was actually making higher highs. Right, just before that huge dip.
What year? 2009? This?
Yeah. Oh, that was a GFC?
Yeah.
Oh.
Yeah, earnings collapsed, price collapsed. Yeah. Key here is just to get the theme. Okay. But we're going to take some more questions at the end, but go ahead.
In the Robert Schiller chart,
yes.
what's the lag time between S&P 500 earnings being announced and the ultimate share price being realized? How long does it take for an earnings announcement to translate into a stock price?
It depends if you believe in efficient market theory or not. And the answer is, I mean, the Schiller cyclically adjusted PE ratio is an average over time. Right now, it's at the highest ratio that it's been since the 2000 tech peak. So, you know, I think there are pockets of the market that are ahead of their skis right now, which I referenced a bit this morning, that are probably going to come in a little bit. And there are other areas that are dramatically undervalued that are going to rip when that happens, but it's just a waiting game. This is Warren Buffett lost his touch 98, 99, and then he crushed everyone from 2000 to 2004 while they were, their face was in their soup on 90% drawdown in the NASDAQ. He had 3 or 4 of his best performing years. So it's putting in perspective. Okay, structural advantage number 2. So what was number 1 was time horizon. Number 2 is temperament. Our edge is the discipline to drown out the noise, capitalize on periods of maximum pessimism, and avoid euphoria and FOMO. The joke is when God was handing out FOMO jeans, he missed Tom Hayes. I never got one. Wall Street's the only store when a clearance sale is held, everyone runs out of the store. It's the exact opposite. On Thanksgiving Eve, they hold a clearance sale on televisions. People are tripping over each other to get in the store. On Wall Street, prices go down, people run out of the store, and you can take advantage of that. Upgrades and enthusiasm arrive after the price move has already occurred, while the real opportunity sits at the point of maximum pain, precisely where consensus is unwilling to go. This leads me to the one conclusion: temperament matters far more than intellect, and Isaac Newton and the South Sea bubble are case in point. So these cycles continue to repeat, and it doesn't matter the IQ. Oftentimes, the higher the IQ, the more the trouble you get yourself into. So if you had to look at defensive stocks right now, where do you think we are on the spectrum of emotion? If it comes to healthcare and staples, are you at euphoria or are you at despondency?
Closer to despondency.
Despondency. What about memory stocks?
Euphoria.
Euphoria. Okay. All right. So basically, Newton invested a little bit in the South Sea Company. He exited at a double. You can see here from 200 to 400. The problem was, after he exited at a double, all his friends were getting wealthier and buying new horse and buggies. And he couldn't stand it. So he watched them continue to get wealthier and wealthier. And finally, he just had to get in, like many retail investors in semiconductors in late June. And then what happened in July? The trap door opened. But that didn't happen for Newton. Newton actually started to make some money. And he's like, oh, I was right. Maybe I sold too early down here. And he held on. And he rode it all the way up. And the problem is the psychology around it. So the amount of mental wrangling he had to do to re-enter up here, so that once it kept going, he kept getting confirmatory bias, and then you shift to recency bias. Well, this is just a little pullback. It's going to go back up. Oh, maybe I'll buy more. This is just temporary. Now, if I could buy it up here, it's so much cheaper down here. I could get more. And then Newton exits broke and despondent just a few years later. So one of the smartest guys of all time falls to the same thing that everyday investors do on a regular basis. So I want to show you some case studies so you can get a sense of what we do. This was ExxonMobil during COVID. If you remember, during COVID period, they were paying you to take barrels of oil off their hands. Oil prices actually went negative for a short while, a few months after COVID. So we were able to, and this speaks to what we try to do in terms of dislocation. When prices are really down and despondent in one particular sector or area, we're not taking additional risk. There's enough risk in the sector. So what we try to do is buy the highest quality assets in the most dislocated sectors at the time. So at that point, when oil turned negative and managers were getting fired for owning anything that had carbon whatsoever, and the Green Revolution was full tilt boogie, full steam, and you weren't allowed to own this, we wanted to get exposure to energy, but the highest quality asset in the most dislocated sector was not Carrizo Oil and Gas in West Texas with a 3 times levered balance sheet. It was ExxonMobil. And our thesis was if ExxonMobil goes out of business, we got a lot more to worry about than our stock portfolio. So we were able to buy a ton of it at $33, and that went up pretty quickly. So again, going on to the theme of the highest quality assets in the most dislocated sectors.
Did you sell it?
Yeah, we sold that at a triple, just over 100. Yeah.
That's your rule. You hit the triple and out you go.
No, it's not a rule. It's just that we never enter a position without determining where we're getting out, and we predetermine that's where we would be comfortable getting out and taking profits. Because it's not a question of like we didn't think it was going to go higher. It's a question of highest and best use of capital. And after a stock's had that big of a move in that short period of time, I can hold it for another year while it consolidates, and then my IRR on the overall investment goes down over time. Or I can take an excessively high IRR, hit the window, and redeploy into things that I think are just leaving the station versus already, cruising at 30,000 feet. And I think that, in fact, proved to be the case. Yeah, proved to be the case with Exxon. I mean, it consolidated for 3 years after that, before taking the next leg higher. So that would have, even though the price went higher over time, the IRR would have been destroyed by burning that 3 years waiting for it to take the next leg higher. So. Okay, Wells Fargo, banks were in the toilet, same time period. This one put me on the map. It got picked up. We wrote it up on our blog, hedgefundtips.com. Every week we write up one or two of our positions, new and existing, all the rationale behind it, why we're in it, if it's an existing, what's changed, how it's developing according to thesis, if it's new, why we're investing in it in the first place. Wells Fargo was trading at a 50% discount to tangible book. It had only done that 2 other times in its 100+ year history. And our thesis was the same: the end of the world only comes once. And if this is it, we don't have to worry about our portfolio. But if it's not, this is a generational opportunity to buy Wells Fargo. And our blended basis was $25.10, and that was a quick double. And we just traded that one up to tangible book because, yeah, you can get a premium over tangible book. But, it wasn't like a great business. But again, we weren't buying, Fifth Third Bank or Silicon Valley National Bank for like a 5-bagger. We were buying like we could sleep like a baby at night. People think, Tom Hayes doesn't like tech. Couldn't be further from the truth. Again, don't mistake a great theme with a great entry point, okay? We love tech. We just like it at different times than most people like it. And we loved it in 2022 when you couldn't give away a tech stock. But again, we weren't buying Sienna or what are the hottest photonics companies that they're all tripping over themselves these days that they were talking about. Anyway, we weren't buying stuff at the fringes. We were buying the highest quality assets in the most dislocated sector, which was tech. We were buying Amazon and we were buying Google, and those were quick doubles and triples and not hard to sleep at night. But no one wanted them back then. And that was what made them interesting and attractive. That was the Google one. Then Rolls-Royce. This one kind of hurts. So Rolls-Royce is not the car maker. That's a separate business. Well, it was, but this was a play on engine servicing hours post-COVID. Okay, so they make their money servicing engines, and then they had this call option on SMRs, small nuclear reactors. They were kind of ahead of the curve on that. But we were basically like, flying's going to come back. Their normalized earnings power is going to come back. There's a moat. Planes are not going out of business. They're not going to, the horse and buggy was replaced by a car. Nothing's really going to replace the airlines. People will come out of COVID, blah, blah, blah. So we bought the thing. It was like $150. And we had done an analysis because they actually had issued a lot of stock during COVID. So they had diluted the shareholders already. And on that basis, we figured because they had doubled the share count, the highest it could get to was like, it's like $9. So we got in maybe $150, sold at $7 because of all the dilution. But the market went crazy with the narrative about small nuclear reactions. So we were brilliant. $1.50, get out at $7, short period of time, the thing goes to 21. So, if you can't take a joke, but, world's smallest violin. Then there was a company, so think back about 3 years ago, one of the other things we like to look for is something called uninvestable. Okay, that when that's just a euphemism for the price has gone down a lot. Okay, and a few years ago, and you know it better than anyone else if you live in San Francisco, you couldn't give away an office building. Okay, like people are saying no one's ever going to go back to office, blah 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 blah. So we're like, okay, that's probably true at the margins, which will affect B and C properties. But if we stick to our knitting and we buy the highest quality assets in the most dislocated sector, which was office, we can probably make some money if we just can sit tight, and we've done our solvency analysis, our jockey analysis, our catalyst analysis. So we bought the highest quality buildings in the greatest city in the world, which is New York City, in a business called Vornado, which Steve Roth and the guy, knows how to make money, and everyone said we were crazy. And this was one of those examples. We expect these doubles and triples to take 3 to 5 years. This one took a year and we were out because it got ahead of itself. Just like it overshoots on the downside, sometimes they overshoot on the upside. We hit the window and we were like, you're paying us for what's going to actually happen 3 years from now. We're good. Thank you very much. We rung the register on that. Intel. Okay, see, Tom Hayes, turnaround Tom does love tech. He just likes it at the right price. So you may remember a little company called Intel. Everyone said was a bag of you-know-what. Couldn't give it away at $19, $22 a book value. Going out of business, blah, blah, blah. Except for the fact that we had a national security problem, which is Taiwan Semiconductor makes all the chips. China's waiting to go into Taiwan. Will they ever do it? We don't know. But the administration had a problem on their hands given the way the economy's going and everything else. They had to stand someone up. The only one they could stand up is the one that was at the 10-yard line. So the board, opinion follows trend. The board told Pat Gelsinger, you can do all this and invest all this money. The problem was the stock price went down. So the board makes a calculation. I can show up for 4 meetings a year, make $400,000, and do nothing, and keep doing that. But I gotta cut Gelsinger's head off at the 10-yard line, even though I told him to do what he did. He's going to be our sacrificial lamb. And Lip Bhutan came in. He takes the football at the 10-yard line, walks across the touchdown, spikes the football. The stock goes up. So the moral of the story is I would go on Varney, Fox Business, and I would say, listen, Stu, here's the bottom line. If they liquidate the whole damn company today, because that's where the pessimism was, I'm getting $22. The legacy CPU business, I know no one wants CPUs, Stu. People only want GPUs because this is when NVIDIA was going straight up before it consolidated sideways for the last 2 years, by the way. The legacy business is cyclical. It deals with computers and it deals with phones and other things, is worth $45 a share. So forget GPUs. Oh, and by the way, if they get anything right with advanced chip manufacturing, even a whiff, it could be a $100 stock. Okay? So we knew where we were getting in before we got out. And it shot up to 96, 97. We're hitting the window. Sold to you. Everyone's super excited about Intel. Couldn't give it away at 19. Everyone wanted it at 100. And then, of course, it went to 140 after that. Overshoots on the downside, overshoots on the upside. Now it's back to 89, maybe 91 today. Probably going to 60 before it goes to 200, if it ever goes to 200. So that's that. Albemarle, we talked about this morning. You couldn't give away lithium, very cyclical. Sometimes things get so cheap you can't ignore them. This one we thought would take 3 to 5 years. It was a triple in a year. We hit the window. We're like, thank you. Now everyone on the podcast is asking like, oh, now it went back down. Are you going to buy it? No, we're good. On to the next. Yeah. All right, current opportunities. How are we doing on time? Oh, we're doing pretty good. So we'll be able to do some questions too. Okay, PayPal. Okay, PayPal, we started buying around 60. They did a surprise change on the CEO. It dropped to 38. The best thing about that was I was scheduled to be on a TV appearance that morning, and I had already put in my notes to talk about PayPal. And the thing's down like 20%. And I'm like, I love PayPal, and here's why, and it was so brutal. But really I was like, I need to finish up this segment so I can get into the market and buy more PayPal, because the end of the day, they're generating $6 billion of free cash. It just got cheaper. This is a unique opportunity. Venmo's growing at 20%. Buy now, pay later is growing at 20%. Margins have just started to re-inflect to the upside. The reason PayPal dropped from $300 down to $38 is, while, by the way, generating record revenue, record earnings, record free cash flow, is because margins compressed. The reason margins compressed is because they bought a business called Braintree, okay? And Braintree is unbranded checkout, meaning people are like, oh, I haven't used PayPal in a year or whatever. How could you buy PayPal? It's like, okay, did you take an Uber today? Yes. You paid PayPal. You don't even know it because they run all the processing for Uber. Have you gone to a concert lately? You paid PayPal through Braintree, which they own, because they run all the processing for Ticketmaster. $1.7 trillion a year in processing. So it's not a small business. The problem is the PayPal checkout button that everyone knows on a retail basis is very high margin. And the Braintree business, which no one knows that they're paying PayPal, is a very low margin. Guess which one grew faster? The lower margin business, right? Because how many people take Ubers every day, and how many people order tickets every day, and so on. So that grew much faster, which even though cash flow per share, revenue per share, earnings per share was going up, the margins were contracting because the lower margin business was growing faster than the higher margin business. So now they've inflected that. They fired a bunch of unprofitable customers. They've got 439 million users around the world. Margins are inflecting, and there's a guy named Mark Grether. Mark Grether started and created the ad business for Amazon. Most people don't know that ad business is 50% of Amazon's annual operating income. So most people look at Amazon, they go, oh, they make money selling all this stuff to us at cost and blah, blah, blah. Or they make all this money in Amazon Web Services. Well, that Amazon Web Services is true, but what most people don't know is 50% of the operating income comes from the ad business that he started from scratch, which is a $60 billion business, maybe an 80% margin business. Okay, so that's the good news. So then he leaves PayPal and he goes and does the exact same thing for a company called Uber. And he starts the ad business there. In a couple years, it's $2 billion, 75-80% margin business, straight to the bottom line for Uber. Now, he's been with PayPal. And the advantage of PayPal is that they have not only data like Uber has, they have the purchasing history of pretty much 439 million users for the last 25 some odd years. And if you can't figure out how to monetize that, I don't know what you can figure out to monetize. So whether it's going to be a $50 billion bottom line business like Amazon, probably not, or 1.7 billion of new free cash flow to the bottom line that no one's accounted into their models yet, which is going to dramatically increase overall margins for the business, which is more likely. That's not priced into any models that I've seen on the sell side, and that is a huge call option. So the good news is they offered Stripe and Advent offered $60.50. The board rejected it. Now they're back in talks. The best thing that could happen to this stock is that the board rejects all offers unless it starts with an 8 handle. 8 handle would be, I'd live with. It's fine. It's okay. It's a lot of money in a short period of time. It's a good IRR. But I'd rather they just blow it up, let the stock trade back down to 40, buy a ton more stock, run the turnaround, and it'll be $120 stock in the next 2, 3, 4 years. That would be my druthers, but my guess is, they wind up doing a dumb deal, $75, $80. We make a ton of money and move on to the next. So that's that. All right, so I did that all off the top of my head. By the way, they're buying in 15% of the stock per year. So even if they don't grow, your share of the pie gets bigger versus smaller. And that's that. Cooper Standard. So we began building this position in 2022. The stock was down from $146 down to $7. We started buying at $7, dropped to $5, we bought more, dropped to $3, we bought a lot more. And there was existential risk because they are an auto parts supplier. They do the sealing systems around the doors and windows. They do fluid transfer systems. And their biggest customers are basically Ford, GM, Stellantis. They're doing a lot of business in China now and so on. The key here is if you look at when the stock was $146 in 2017, that correlates with the peak in the auto cycle, which is US SAR, which is sell-through for automobiles in the United States. And if you look at sell-through of automobiles in the United States since 1980, every cycle it peaks at around 17 to 18 million vehicles, and it troughs at 15 to 16 million vehicles. In this most recent cycle, it troughed at 15 million, which is why the stock was down. They had to refinance some debt. They were successful in refinancing the debt. The stock shot up to 20. They took $400 million of costs out of the business. Here's the number one thing you need to know about this stock is in 2017, on 17 million cars in the US, 17.1, they earned $7.19 a share. They had a 20 times multiple, and it was a $146 stock. We're currently, we troughed around 15, which was when the stock was $5. We're currently at about 15.9 to 16.1, so closer to the bottom end of the normal cycle of car replacement. Because of the $500 million that they've pulled out of the business in costs, at the next cycle peak of 17 million cars, which may even be 18 million just because of demographics, the millennials, 34 years old, housing formation, family formation. That's number one. The number of licensees, people getting licenses is at record highs. Oh, and by the way, the population is orders of magnitude larger today than it was in the cycles in the 1980s when SAR was peaking out, still at 17 million at peak cycle. So the point that I'm making to you is it's only a matter of time before we're at 17 million and possibly 18 million, and the amount of embedded leverage in this business and how they've structured it for the next cycle is mind-boggling. They, at the next cycle peak, which is probably 2 to 3 years out, they will not earn $7.19 like they did in 2017. Based on how they're running the business today, I think they'll earn more likely $10 a share. The only question is, will they trade at a 20 times multiple like they did in 2017? In other words, will the market be euphoric about auto suppliers, in which case it's a $200 stock? Or will it trade at a trough multiple historically, which would be 10 times on $10 of earnings, which is still a $100 stock, which is still a multi-bagger from here. So, and if you'd been listening to my podcast, you'd have a 20 bagger at $100. But that's for another story. That you'll have the next 20 bagger. So that's that. But still a lot of upside. Jeff Edwards has done an incredible job, and Jeff is one example. I always joke, you don't hire the arsonist to put out the fire. He was the same CEO that was in 2017 and rode this thing down. But in his case, he couldn't predict COVID. He wasn't prepared for COVID. The business is not the greatest business to be in on the downside. It's the greatest business to be in on the upside because of all the embedded operating leverage, meaning every additional unit just shoots straight to the bottom line once the fixed costs are covered. And that's what we love about it. And we modeled it after a business, a trade that Charlie Munger did in the early 2000s with Tenneco. Same type of thing. They had a refinancing issue. He bought it at a couple bucks. He made a 5-bagger, got out. The thing doubled again. He would have had a 10-bagger. Okay, so that's the story there. The other thing that's the reason that to learn a lot more this cycle is our model was predicated on ICEs, which is internal combustion engines, which is all they were doing in 2017. Their cost per vehicle, the benefit that they get for hybrids and EVs, they sell many more parts on those cars, and the composition of their clients is skewing towards hybrids and EVs, particularly hybrids right now, which is giving them probably a 60% bump in cost per car that they benefit. So if they would do $10 on ICEs, the composition is going to be more skewed to the composition is going to be more skewed to the higher profitability cars. So they could earn more than $10. And then finally is Alibaba Group. And then we got to stop according to Madison, and we've got to take a couple questions. Alibaba, we started buying this above 100, dropped to 80, we bought more, dropped to 58, we bought until our fingers bled. Our basis is $82. But at the same time, when it got crushed and everyone was saying Alibaba was uninvestable, they were generating $25 billion of free cash flow, $80 billion on the balance sheet. No one was even talking about AI. But what they were talking about was how uninvestable China was. The same analyst that upgraded Alibaba at 300 from Morgan Stanley was the same one that downgraded it at $58 in the hole, just FYI. So take your sell side research with a grain of salt. So what happened was the stock recovered. You got the AI narrative. China consumer came back. The stock tripled, but we bought a ton of long-dated call spreads in the hole, and the expected value on those was greater than 7x. We realized at 7x. So we were able to buy 125, 130 call spreads at 60 cents and sell out at 420 during that move. We still own, so we took that, we rang the register with that. We still own the stock because we think this is a $300 stock over time. It's the cheapest AI play in the world. They have equity positions in pretty much every AI startup in China. So during this downturn, these companies would come to them and say, we need compute. They say, no problem. We'll give you compute free of charge. You're going to give us equity in your company. So it's effectively an Asia AI play that's not priced in. And a lot of these companies are starting to go public. You own a third of Ant Financial. You have a call option on the Chinese consumer. And their AI revenues are growing triple digits every quarter for the last 12 quarters. And no one's paying attention to it. So this is going to be the next play. And that's my contact information. Anyone that has any questions, feel free to stick around. I'm happy to do that. And thank you so much for coming to this breakout room. This has been amazing. So very grateful. Yeah.
Can you share a couple of examples of picks that didn't work out?
Yeah, one I always share is a company called Range Resources. So Range Resources got up to like $90 in 2014. It's a natural gas producer in Marcellus Shale. It fallen 80% plus to $11. We bought a ton of stock at $11 because we assessed the proved and unproved reserves were worth about $60 a share. It immediately went to 18. We thought we were geniuses. And then this thing called COVID came along. Stock fell to $1 and change. We bought until our fingers bled and brought our basis down to $4.10. And today it's trading at about 30 or $35, still going to 60. So that one was just an impairment of IRR, but I think off a 410 basis, when we get out at 60 or so, it'll have worked out. It just took a long time, And those are things that you can't know that you can't know. Like you couldn't predict COVID, but it's also why you have a portfolio of 8 to 12 stocks and not a portfolio of 1. So. Yeah, but the point is, if you do the work and you underwrite it properly, even those temporary impairments in price, nothing changed in the underlying value. The proved and unproved reserves were still worth $60 a share. It's just people got crazy, when the world shut down. Yeah. Yeah.
You lost money on that or
not? No, we still own it. Yeah. So.
One question. First of all, thank you so much, Tom, for all the value you give.
Thank you.
You really helped shape how I think about investing.
Thank you.
Which has come a long way from trading GME and AMC in 2020.
Oh my gosh.
Going up an account to save the price of tuition.
Wow.
And I bought Alibaba when Charlie Munger did.
Yeah.
The stock went down. I didn't do any research on it.
Yeah.
And then I'm like, who else is buying Alibaba? And then I came across you.
Yeah.
So whatever happens with that investment, I'm glad it brought me to your podcast.
Oh, well, thank you.
I have a question for you in terms of how you think about like portfolio allocation, like personal accounts, for example.
Yeah.
So if I think about PayPal or Alibaba in my case, I was very excited about the companies when I did my fundamental research. I thought, okay, I know where I'm underwriting this.
Yep.
The stock kept going down.
Yep.
Which made me buy more.
Yep.
And then the allocation at some point, I feel like it just became a a lot more.
Yeah.
How do you kind of think?
Yeah, like when you're in a position that goes up a lot and now it's like, you know, if it was like a 15% position, now it's a 30% position, how do you think about it?
Or actually on the downside, right? So if you start buying like Alibaba, let's say at 100, it's already a 15% position. It goes down way lower, like how PayPal did at 39.
Yeah.
You know, they can buy back 15% of the company. Like,
yeah.
I need to allocate more, but the allocation now is getting a lot larger.
Yeah, I usually max out at 20% of capital. Like, and that has to be a super high conviction position that, like, if the world was a certain place, I'd be willing to put 100% of the money, which I never would because the world's not a certain place. But I think 20% your cap. You know, that becomes the level where it's like enough's enough. Yeah.
I don't remember my history. Is Musk still involved with PayPal as a
No.
investor or shares? Or
No, but he could be potentially a competitive bidder. We'll see what happens.
I walked in late when you were talking about PayPal. Were you recommending it or were you not recommending it?
It's moved up a lot because they got a buyout offer. So it's going to be a binary outcome, okay? Either they're going to do a deal, probably, my guess, $75, $80, maybe less, if they're a dumb board. So you'll make a little bit of money. They blow it up, they don't do a deal. It goes down into the 40s before it goes back. But if they just run their turnaround plan, we think over the next 3 years, it's 120 plus, maybe 150, because all the cylinders are starting to hit and no one's paying attention to the ad business and how accretive that's going to be for the business. So our best case scenario, we'd love the deal to blow up, the stock to go down, we buy more position, and we wait 3 years to get a triple. So the short answer is, like, do you buy it after it's gone from 40 to 60 in the last couple of months? I mean, that's game theory. So, like, if you get a deal at $75, you make a quick 20%. Is that worth it? If you don't get a deal, you're going to be down 20, 25% temporarily, which means you can average down. So maybe you buy a half a position if you like it. If it goes up, you made a quick buck. If it goes down, you get your full position, you bring your basis down, and then you ride it for the next 3 years. That's probably how I would think about it. I'm not advising you. It's opinion, not advice, but it's a good question. Yeah.
I won't ask you for advice.
Yeah, opinion.
I tried to ask you for tax advice and I realized I shouldn't have done that.
Yeah.
Hormel is one of your holdings.
Yeah.
Do you have any commentary on their management change?
I mean, this is a business that they could work 24/7 and try to kill it and not kill it. It's going to be fine. They've been raising the dividend for 65 years. They're changing management. At the end of the day, the product complex is fine. The business is fine. We'll look at it in the next couple of days, and I can tell you more likely than not, we're going to be a buyer in the market in the next few days. But I have to spend some time on the earnings, and on balance, we're comfortable with that position and probably going to be adding to it. Yeah.
Hormel. Everybody loves spam, right?
Yeah, spam, planters, Skippy, GLP-1 perfection. It's all protein, so can't go wrong there. Anything else?
How do people know what you have in your fund?
We talk about it every week on the podcast.
The podcast,
yeah.
And what, you go to YouTube and
yeah. Yeah, just put in Hedge Fund Tips with Tom Hayes.
Your thoughts on Meta?
No view. I'm not a buyer here. I'm not a seller. I'm just not involved.
You don't hold it?
No. When people hate it, I'll be interested. Right now, it's had a run. It's fine. They paid it. They settled. Not for me at these levels. And we're back. And then want to thank everyone who has been sharing the podcast. As we say, we'll do this for clients every week forever. We open it up to the public because you guys have been really helpful in sharing it and growing it. So all we ask each week, if you're getting value, share it with one person you care about that would benefit from this material, number one. And number two, on YouTube, go in the comments section. And if you're finding it valuable, leave a comment. That helps YouTube show it to more people, like-minded people, and we keep growing. We'll keep putting this out for you guys. Very appreciative. And many of you find it easiest to share it by wearing some of the merch, which you can find at hedgefundtips.com. And while you're there, click here on terms. This is all opinion, not advice. And I gotta love, oh my gosh, I love this hat by Jack Hazard. The opinion follows trend. Hedge fund tips hat. He's gobbling down on some lobster. I think this is probably the best photo picture we've ever had. We got Dr. Chen sending in another photo and so on and so forth. So get your photo up. Order a hat, order a mug, order a t-shirt, order a hoodie. Send it to info@hedgefundtips.com like our boy Jack did this week. And literally, this is the best photo we've ever got. Opinion follows trend. I think it's so cool. What a cool hat. So go ahead and do that. And as a matter of fact, our friends over at Fiore Golf, who sent us these incredible shirts gratis, whoever sends in, because we get like now it's like 30-to-1 orders to pictures. People are shy to put their pictures. So the first person to email their picture wearing the merch, who hasn't already emailed a picture wearing the merch or using the merch, to info@hedgefundtips.com. We're going to mail you this limited edition Fiore Hedge Fund Tips golf shirt. They fit great. You're going to love it. So send them in and let's keep the machine going and keep the growth going. All right. Quote of the week. Most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what's popular and do well. That is from the GOAT, Warren Buffett. And what we say in our podcast is beware of chasing shiny objects. You know, it's funny. I was just on the phone with a friend and client, and he was telling me, you know, there are a couple firms out pushing these tax loss harvesting funds where you defer taxes for a bunch of years, and you know, you all know about them and everything else. And you know, they came to speak to a business networking group that I'm a part of. I asked them 3 simple questions they couldn't give me an answer to, but all I could tell you is this: beware of financial advisors whose headline is "We're really great at generating losses for you." That usually doesn't work out well over time. Be happy with gains, pay some taxes. You know, we can't use used missiles with our military. You know, if you make a lot, sometimes you got to contribute back to the till, and there's nothing wrong with that. Except for the real estate people. They figure out how to never pay taxes, so God bless them. All of the professional real estate people and depreciation and the way that the tax code's set up so that we can provide shelter to as many people as possible, and office space and storage space and all that other stuff. And you know, show me the incentive, I'll show you the outcome. The government wants housing, they offer incentives, they get housing, and that's the way it should be. Charlie Munger, a lot of people with high IQs are terrible investors because they've got terrible temperaments. That's from Charlie Munger himself. Let's get on to some data. Friend Damien, who you saw in the picture, sent this book over called 1873. Oh, wrong book. Okay. The book that he was referencing, that is the book. It is 1873. It's by Liaquat Ahmed. The Rothschilds, the First Great Depression, and the Making of the Modern World. They cover the railroad build-out of 1873, as he's made the AI comparison himself explicitly in his own words. So the framework below is his extended with .com telecom cycle sitting in between the two. So in the railroad cycle, and why we're covering this is because of the parallels to the AI build-out cycle. And I built this chart, which I'll explain to you in a little bit. Ahmed dates the exuberance from roughly 1867 to 1873. The U.S. network, this is of railroads, doubled from 35,000 to 75,000 miles between 1865 and 1872, with 33,000 miles laid in 1868 to 1873 alone, and construction peaking at 7,500 miles in 1872. Spending peaked near $400 million a year, close to 5% of GDP. That's very important, ladies and gentlemen. Remember that number, 5% of GDP. Over 3/4 of its bonds financed. Okay, sounds like right now, right? With the hyperscalers doing all the debt financing. Cracks showed before the break. By the fall of 1872, barely 100 of 350 railroads paid dividends. And by early 1873, Jay Cooke had raised only $14 million of the $100 million he'd promised the Northern Pacific. The trigger sequence was fast. Vienna crashed May 9th, 1873. J. Cook and Company failed September 18th, and the NASDAQ, the NYSE, shut for 10 days from September 20th. Then the slow part, railway stocks fell 50% from 1873 to 1877. A third of railway bonds went into receivership, 1874 to 1876. The worst 3-year corporate default stretch in U.S. history, worse than the 1930s. Construction collapsed from 7,500 miles to 1,600 by 1875, and the U.S. Depression didn't end until spring 1879. Prices then fell for roughly a quarter century. Now, compare that to the internet telecom cycle. NASDAQ rose 600% from 1995 to its March 10th, 2000 peak of 5,084, then fell 78% into, this is not one stock, this is the whole index, into the October 9th, 2022 trough, erasing about $5 trillion of wealth. The physical analog to the railroad mileage was fiber. Over $500 billion invested in 5 years after the 1996 Telecom Act, mostly debt financed, with the FCC chairman testifying in July 2002 that the industry owed $1 trillion, much of which will never be repaid. Bondholders recovered just over 20% of what they had invested. Ahmed measures this the same way he measures railroads. IT investment went from 3% of GDP to nearly, 5% of GDP at the peak. Pay attention to this number. NASDAQ didn't close above its 2000 high again until April 23rd, 2015. So if you bought the top when everyone was excited about the internet and you were paying for that 15 years of production, it took you 15 years to get your money back with a 78% drawdown in the interim. Where AI sits, counting from ChatGPT date in late 2022, the boom is about 3.7 years old, the current boom. CapEx is headed north of $1 trillion this year, roughly 2 to 3% of GDP, not 5%. And the funding mix is drifting from retained profits towards corporate bonds, private credit, and securitized SPVs. Hyperscaler bond sales expected to double to $250 billion in 2026 and nearly double again in 2027. That is the shift Ahmed flags as the 1873 rhyme. Cook funding illiquid, long-dated assets with callable short-term money. Nothing yet looks like a dated peak. There have been real drawdowns, a $1 trillion big tech wipeout in February, COPC down 44% in 40 days across late June and early July. Global semis sell off more than 20% from the June high, but indexes were back at record highs by mid-August, with the exception of semiconductors and the NASDAQ, by the way, time will tell. And Merrill reads the semi pullback as a speed bump, noting non-recessionary 20% semi drawdowns since 1999, average over 44% over the next 12 months. What the overlay actually tells you. Okay, now, so here's the chart that I drew. You can see railroads from 1867 to 1896. The boom and the build out lasted about 6 years and change. Then the crash to the trough lasted another 5 years, and then the overhang till the recovery where you'd retaken the high watermark would have taken 29 years if you bought at the top of the railroad boom. The internet boom, 1995 to 2015, the boom was 5 years from 95 to 2000. The crash was another 3 years till 2022, 2023. And then it took you about 15 years to get your back to the high watermark. Then here we are in the AI boom, which is why I continue to say I think we're mid-innings because we're at 3.7 years, and our CapEx in the case of internet hit 5% of GDP. In the case of the railroads, hit 5% of GDP. We're at 2 to 3% of GDP, and we're only about 3.7 years in. So why are we cautious in the short term if this probably has another handful of years potentially to run parabolically? And the answer to that question is this chart, which we've covered, which shows from 1995 to 2000, despite you had this parabolic build out and you got to 5% GDP capex, in the interim, you had aggressive short-term washouts after big moves in semiconductors. The first being 95 to 96, the semiconductor SOX index corrected 56% peak to trough before rallying to new highs. Happened again in 97 to 98, corrected 56.5%. Before rallying to new highs. And then in 2000 was the top, where you got an 85.49% final correction, and it took you 15 plus years to get back to highs. So you can have two conflicting ideas in the same mind and still be prudent, in the sense that, one, we could be mid-cycle because we're only at 2 to 3% of GDP for capex, and we're at 3.7 of what could be a 6, 7, 8 year cycle potentially, and have plenty of room to run. And simultaneously, you could have a bigger washout in semiconductors and memory in the short term and get people washed out where they think the AI trade is over in the sixth inning, and there'll be better chances to buy it. And that's kind of what we're talking out here. What the overlay tells you, the dash segment on the AI bar is open-end, not a forecast. There's no peak to date. Three things stand out. First, boom phase is clustered tightly at 5 to 7 years. AI at 3.7 years is inside that window, but not yet at its far edge. Second, the crash is the short part, 2.6 years for the NASDAQ, about 5 years for the railroads, while the overhang is the long part, 12 to 17 years, and that asymmetry is the whole lesson. Third, the peak capex intensity, railroads 5% GDP, fiber 5%, and AI 2 to 3% today, which cuts against AI being the most extreme of the three on the metric Ahmed himself uses. The one dimension where the analogy weakens, railroads and fibers were bond funded from the start, while AI began as a cash flow funded boom and is now only levering up. Ahmed's warning is really about the transition being in progress, but an exogenous shock, the Franco-Prussian War, then the Middle East conflict, and a global liquidity squeeze now landing on it. His closing note is worth keeping. Railroads survived their bust and then drove U.S. growth for half a century. So this is not going to be in vain. This is going to be a situation where the one who bears the bill is not the one who gets the benefit. It's kind of like having a 5-course dinner at Jean-Georges with friends, and then you skip out to the bathroom when the check comes. That's exactly what's going to happen, I think, for those people that are footing the bill for the AI build out. I think it's going to be the beneficiaries that actually apply the technology to their business. And as I've said in the past, it's why Bezos was raising $100 billion, not to fund AI startups or hyperscalers, but rather to fund manufacturing, the purchase of manufacturing and industrial businesses that will apply AI in these quote unquote old fashioned businesses to double margins, kind of the Brad Jacobs playbook that he's been doing for decades as technology has evolved. Objectively looking at this, my comments, probably another, 3 to 6 years with a few aggressive washouts along the way, like the 3 times semiconductor index fell 50% from 1995 to 2000. Okay, historical short interest of iShares 20-plus year Treasury bond ETF. You've never seen this much shorting in it. Every other instance where the shorting has even been elevated, half of this has been a huge opportunity to buy bonds. I know Druckenmiller's out, giving Besson a hard time about Operation Twist. If you remember, I was on Fox Business, Varney, 4 or 5 months ago with an economist, and they were saying that, it couldn't be done. And I said, you just wait. They're going to do Operation Twist again. Well, guess what's happening? They're doing Operation Twist again. They're going to bring rates down. and people are going to be scratching their head as to how that happened. S&P, this is not a short on the British pound, so applying that framework on this situation is probably not going to end well. You don't want to bet against the man with the biggest checkbook in the world, and he will be effective in the intermediate term in doing what he sets out to do. In the long term, the market may discipline him. I'm not disagreeing fully with that, but by then you may have deflation coming from AI anyway, and the overall economy will make it unnecessary for them to go out and buy the long end of the curve and cut on the short end of the curve over the next over time. Okay, there's semiconductors at another peak you see before they get corrections. Earnings peak expectations, then you get corrections. Earnings peak expectations, then you get corrections, etc. S&P flows, you can't get more bubblish than that. So I think we get one of those intermediate term flush outs, but it doesn't mean the AI trade is over. It probably is, sixth inning, fifth inning, that type of thing. Well, there'll be better spots to buy. Don't mistake, as I said on Varney, don't mistake a great theme with a great entry point. Alibaba's cloud business revenue growth accelerates, 45% growth in the June quarter, absolutely crushing it. Percent of S&P 500 stocks with dividends greater than the 10-year yield. You haven't seen this type of compression since 2000 and the tech lows in 2000. And that's the time you wanted to be a buyer of these type of dividend stock. Commodities versus equities. Again, opportunity there in the Comstock resources. And here is the cycle composite for 2026. We're at the peak of the cycle where you get some end of August strength. But if you look back at the average data going back to 1928 in a midterm election year, this places equal weight on the 1-year seasonal cycle. So this is like the annual playbook, then the 4-year presidential cycle, which is the midterm playbook, and the 10-year decennial cycle, which is the 6th year of the 10 years, tends to get weakness in early September, late August, early September through October. So we'll see if Warsh and or NVIDIA has anything to do with that. Everyone is consensus is the numbers are going to be great for NVIDIA. That has been the case for the last few quarters, and the stock is still sold off. We'll see what happens tonight, but you won't know till tomorrow because you're getting this tomorrow, but it is what it is. All right. Note of the collapse of beta. Okay. Operating earnings per share, same as 2021. When everyone was excited, then expectations pulled back. You got a little correction in tech in 2022. Consumer spending expected to slow, not stall. I think back to school might wind up being better than most people think. Alibaba Quen model breaks the agentic cost curve. They're crushing it. Lower cost, better output. Watch out, Anthropic and OpenAI. U.S. admin won't open weight versus closed weight. U.S. admin won't let 30-year Treasury yield cross 5%. Maginot line, we'll see if they can hold that in. So far, the jawboning seems to be working. We'll find out if they have to actually take action on September 9th. Here's the bull bear indicator by Bank of America. This is not where you want to be putting new money to work in crowded, frothy trades. This is where if you're putting new money to work, you want to be on the more defensive stocks or the things that are left behind, because as the indices come in, people will look to hide in those things that have lagged. Earnings revisions versus PMI. PMI is turning up. Here's the 10-year yield up against this top range that we saw in 2023, 2024, 2025, and it always seems to bounce down off of that into the high threes. I think this time will be no different. I think there is a trade to be had on getting long TLT, but that's all opinion, not advice. Seasonal composite midterm election year, same thing. Similar to what we talked about the 4-cycle composite, there tends to be weakness for the next 6 to 7 weeks. U.S. business activity accelerates in August. That's a positive. The PMIs have been good. We've been waiting for that. That's happening. Retail resurgence, 5-day net buying of single stocks on Robinhood's markets. They're chasing semis back while Citadel's getting out and liquefying the portfolio they bought from situational awareness. Retail's piling in. Again, it's not going to end well, just like in June. Sentiment and consumer improved to a 4-year high Do not bet against the U.S. consumer when they have a job. I know they've been down and out. Consumer discretionary, restaurants, athletic wear. We saw Dick's. You saw Nike, VF Corp, Goose having some pressure because of the tariff nonsense negotiation. At the end of the day, these things will bounce back. U.S. government and corporate debt, 1950 to 2025. The playbook in 1950, when government debt was 120% of GDP, was to grow your way out of it. They're trying to do it in the U.S. Very hard to do when you're fighting a war in Iran. Going to have to get that resolved. They're going to have to do some aggressive growth policies. Going to be very hard to outgrow it because they've lost a year screwing around with the Iran situation. So, but not impossible. Time will tell, and maybe they'll get a tailwind of right place, right time with AI productivity. Cox Automotive, Moody's Analytics Vehicle Affordable Index coming down to near pre-COVID levels, which should increase volumes, which will help Cooper Standard. And the stock price will bounce temporarily around tariff rhetoric and bullshit, but ultimately it's going to $8 or $10 of earnings, and the stock's going to be much higher over time. Realized and consensus EPS growth for select U.S. equity indexes. Bottom-up consensus, okay. S&P doesn't own leadership. Median stock carried elevated short interest. Okay. Positive earnings surprises, growth coming from top and bottom line. Again, this is correct, but I think expectations are ahead over their skis like they were in Q4 of 2021. The general economy is very good, and will continue to improve over the next couple of years. I think in the short term, though, I think some of the prices ahead of the skis related to expectations that might be a little bit higher than what actually plays out, despite what playing out being solid and being expansionary, not contractionary. U.S. household leverage coming down materially, so that's, again, good for the consumer. Dollar index rolling back over. People were not expecting that. That's going to be the theme for the next 2 years. We've continued to pound the table on that. Those with the loonies in Canada, you're going to be fine. They're going to keep going up, but continue to bet on dollar weaker next couple of years. VIX seasonality, this is the time of year when it turns up. Again, this is all probabilistic. There's some people saying we pulled forward the volatility in earlier in the spring with the Iran stuff. It may be true, but I wouldn't make aggressive bets going into this weakening period. If you're wrong, you'll still have an opportunity to buy after the election. You just buy what's lagged behind and playing catch up. Consumers seem to be shifting some of their grocery spending to restaurants. That's good. Restaurants have been in the gutter. They're going to start to recovery. Manufacturing survey and ISM manufacturing. We'd been waiting for this. It started to finally play out in 2026. We were waiting for that in 2025. Good to see. Annual earnings growth forecast. Healthcare is off the charts. We like that theme. Pharmaceuticals, same story. High beta stocks, negative correlation to low beta stocks. You have not seen this type of opportunity. Again, going back to 2000, what did you want to be in 2000? You wanted to be in defensives and staples while the high beta was getting taken out to the woodshed. U.S. averaged realized stock correlation, so lowest in a few years. That's good for a stock pickers market. Treasury bond futures versus bond sentiment composite. Sentiments around bonds is completely washed out at levels not seen since October 2023, right after which time you got a massive rally in bonds, a compression in yields. I think we're set up for the exact same situation, and you can count on the U.S. Treasury refinancing a ton of debt when you actually get that compression in yields, which could be a function of short-term equity volatility in the next 6 to 8 weeks, pushing yields down and now enabling a lot of people, certainly the U.S. government, to refinance as the flight to safety potentially picks up. And maybe it's also a function of the European debt crisis that not a lot of people are paying attention to right now, with yields at 15-year highs and a much different structure than we have here in the U.S. and certainly lacking reserve status. U.S. housing inventory, active listing count going up, supplies going up, prices are going to come down. I know all my buddies in Orange County laugh at me. Prices never go down in Orange County, but zoom out. 2008 they came down. We're not going into 2008, but early 90s when the Japanese money pulled out, they collapsed. Anyway, whatever. I bought the top in Orange County housing, so joke's on me, but I knew that going in. The longer the holding period, the more likely to see gains. No kidding. Okay, CTAs versus bonds. Consumers remain incredibly upbeat on stocks. So, again, right before April, you don't want to be excited about stocks when the crowd is excited about stocks. 493 net income growth is exceeding Mag 7. The 493 and going to do so in an even more pronounced way in 2027. So you can see the tables are turning. 2023 and 2024. Mag 7 left the unmagnificent 493 in the dust in terms of net income growth percentage. That shifted in 25. It's accelerating in 2026 and is going to be game changing in 2027, which means what? You buy the unmagnificent 493, aka equal weight, aka shiny objects are going to be taking a breather. Alibaba signals faster AI payoff, margin gains halfway through $56 billion capex plan. Alibaba announces 10.2 billion share replacement as Chinese companies expand AI investment. I put on X my thoughts on that when the offering was rumored on Friday and the stock was down. Not a big fan of dilution, but they bought in $65 billion of stock below $100, and now they're selling $10 billion at $112. And by the way, among that $10 billion buyers, Jack Ma pulled out his checkbook, the founder of Alibaba, and bought $77 million of stock. That's super exciting. And then some insiders bought another $10 million, so the stock is back up. And so on. Major Alibaba figures make purchases as Chinese giant sells $10 billion of stock. Goldman says Chinese easing hopes revive with economy growing at 4%. After gaining EV dominance, Chinese car makers shift goal to take on full hybrid behemoths. That's where Cooper Standard is. Sweet spot is in the hybrids, doing great business in China. Hyundai bets on U.S. hybrid boom to take on Toyota. A $131 billion shot in the arm. How Boeing's new F-15 deal can help shares. Boeing and 9 more stocks for manufacturing revival from our roundtable pros. That's Barron's. QXO hires a contender for the top job at Honeywell to be the chief operating officer. Brad Jacobs attracts the best talent because he's the best wealth creator for owners. And if you're going to run a business for him, you want stock, and that's why he gets the best people. Stick with value stocks until everyone starts talking about them. They're still under the radar, this Wall Street firm says. We agree with Bank of America's thesis on this. And you could see that article from Barbara Kohlmeier over at MarketWatch. This is a 13-minute interview from the CEO of Estee Lauder, which has just been ripping higher off the lows. We don't have time for that because of all the money show stuff today. So go to Bloomberg Television at Yahoo and search for Estee Lauder CEO says company has great momentum. And we can see, in fact, it does. Why Disney fans are spending $1,100 on a set of pins. Because it's a cult and it's going to continue to be a cult, which is why we own the stock and why it's starting to turn around with Josh tomorrow. Etsy upgraded to buy at Bank of America on durable growth potential, buyback potential. I mean, that's the way it goes, ladies and gentlemen. Opinion follows trend. Stocks up 35-40% off the lows. Now they're upgrading when they were downgrading at $40 and $50 when we were buying till our fingers bled. Now they're upgrading at 85. The stock will go over 100. We'll see what fundamentals continue to look like. Papa John's complete strategic refinancing of Orlando area restaurants with franchise owner Wade Oni. So they're executing exactly what they said they were going to do. That will increase their margins over time. And as the restaurants turn, we believe Papa John's will adequately participate. And with Todd Penegor running it, the turnaround play that he did for Nelson Peltz over at Wendy's when Wendy's was left in the gutter in a much more competitive market, and the guy running the Domino's app that led to all the growth with Domino's now running the rewards for Papa John's, we think the future will be bright. Advanced Auto Parts reports second quarter 2026 results. End of the day, if you listen to the call, they had a weak June through all the Iran stuff going on. It reaccelerated in July. They said on the conference call, doing everything that they said they were going to do, short-term opportunity to top up stock, and we took advantage. U.S. alcoholic, and we'll take advantage in coming weeks as well. U.S. alcoholic beverage consumption stabilizes at historic low. So we've talked about this with all the regions growing for Diageo around the world, except for the U.S. Now it looks like it's stabilizing, and average number of drinks per week inched up to 3.2 from 2.8 the previous year. So that's moving in the right direction. Look, this is not something, it's like, we're not rooting for this in terms, like, they can take enough margin out of the business, we can get a double in the stock. It's like, oh, I hope people smoke more so my Philip Morris stock goes up. Absolutely not. Same thing with this. I don't think it's a great thing for people, but it's just too cheap. They generate too much free cash flow, and you got Drastic Dave running the ship. It's going to continue to power higher as it has been in recent weeks. The AI spending boom is outrunning Wall Street estimates. So that's the bull case on all this memory. We think the stocks have gotten ahead of themselves, are going to flush out. People are going to get pessimistic, and we'll find more interesting places to buy, like when we were buying Intel at 19, selling at 96. We'll have opportunities to buy Intel again in the 60s. Whether we'll take them or not is to be determined, but those opportunities will come. And probably sooner than most people think. NVIDIA customers reportedly warned about AI-related price hikes. So, when you have this situation, it's going to force the customers to look for alternatives, whether that's going to be China, whether that's going to be different ways of running the programs, different models. But you can be assured that necessity is the mother of invention, and that's going to work to their detriment over time. It's kind of like when we said we're not going to ship any chips to China, and China figured out how to make them on their own. Worst thing we ever did. Ken Griffin says Citadel unwound more than 80% of the risk tied to situational awareness portfolio. Why would he do that if he was able to bottom ticket, and now they've had this aggressive short selling rally, and retail is all jumping back in on semis and memory and the AI trade? Why is he getting out of 80%? Because he knows what the hell is up. So institutions are going to use this liquidity to get out. Too many got caught with their pants down in July. July was an amazing month for us. And now they got to find a way to get out. On to the article of the week: growth in the cloud stock market and sentiment results. Alibaba update. For newer readers, by the way, pretty par for the course, ladies and gentlemen. If you look back at 2015, stock bottomed at, IPO'd, got up to 115, bottomed at 54, rallied up to $200, crashed down to 122, then straight up to 301. Not dissimilar. Bottomed in 2022 at 54, rallied up to almost $200, 190 and change, crashed down to 91 for a minute, and now it's going to work its way back over 300 in our humble opinion. So here's our original thesis from back in the day. And by the way, we got no skin in the game because we made so much money on the spreads last year that we've taken all of our basis out of the 7X on the spreads. So we've taken all of our basis and then some on the stock, and now we're off for a free ride back to 300, which we're happy to do. Here is the original thesis and notes. You can go through that at hedgefundtips.com. While you're there, get a hat, read the terms, consult your psychic and financial advisor before doing anything. If you don't have a financial advisor, I know a really good money manager. Hit me up. I'll let you know his name. Alibaba reported Q1 results last Thursday. Not a solicitation. don't call me, I guess, is what I'm supposed to tell you. So don't call me. Alibaba reported Q1 results last Thursday. And for anyone who has followed the name for long, the headlines were predictable. Adjusted EBITDA fell 30% year over year to $4 billion, with margins compressing to 10% from 15.7%. Adjusted EPS fell 42% to $1.26. Other than that, how was the play, Mrs. Lincoln? Free cash flow swung to $6.6 billion outflow on $10 billion of CapEx, up 75% from last year, and 2.6 times sequentially, with profits under pressure and lumpy CapEx timing driving an outflow well above consensus expectations. The financial media had plenty to run with. While those numbers make for some good headlines, digging into the underlying results, something few investors seem willing to do, tells a much different story. Cloud and compute revenue accelerated to 45% growth, the 9th consecutive quarter of acceleration and the fastest pace in 22 quarters. AI-related product revenue reached $1.82 billion, marking a 12th straight quarter of triple-digit growth that can no longer be dismissed as a small base phenomenon. 12th straight quarter of triple-digit growth of AI product revenue. Meanwhile, the e-commerce business grew at 4% while holding profits essentially flat at $5.86 billion, all while absorbing a quick commerce business that has grown from 18.5% of segment revenue a year ago to nearly 26% today, a testament to narrowing losses and improving unit economics. None of this progress got much time in the spotlight. The day after earnings, reports of a possible equity raise pushed the quarterly results straight back to the burner and sent the stock down 9%. On Sunday, Alibaba confirmed a $10.2 billion equity placement of 710 million new shares outside the U.S. at $112 per share, its first issuance since 2019. We have never been fans of shareholder dilution and have been outspoken about it. Every new share reduces the ownership stake of existing holders, and any management team that resorts to equity frequently or indiscriminately deserves scrutiny. That said, if a company is going to raise equity, Alibaba is doing it about as well as it can be done with its track record over the past several years, earning management the benefit of the doubt. From 2022 to 2025, Alibaba retired $44.9 billion of stock cumulatively, averaging $11.2 billion annually. Those buybacks were concentrated with shares trading well below $100 and as low as $59 back when China had been written off as, quote, uninvestable, and few investors wanted anything to do with the name. We were buying right alongside with management until our fingers bled. As the stock recovered and more than doubled off those lows, management eased its foot off the buyback pedal, repurchasing 0 shares in 2 of the last 3 quarters. The $162 million spent this quarter came only after the market got silly again and the stock briefly traded back below $100. In other words, Alibaba bought heavily when the shares were left for dead, stepped back when the price no longer justified it, and is now raising $10.2 billion of capital after retiring more than 4x that amount at a fraction of today's price, effectively playing the capital arbitrage game. That is the exact opposite of the unfortunate but far more common playbook when buybacks peak near their highs and management goes quiet or reaches for the equity market when the stock is actually cheap, ultimately destroying shareholder value rather than creating it. If management's capital allocation track record wasn't enough, the days following the placement provided another vote of confidence. Chairman Joe Tsai purchased 180,000 ADRs for $20.7 million. Eddie Wu bought 43,750 ADRs for $5 million, and founder Jack Ma was separately reported to have added $76.5 million to his already large 4% stake. Combined, that represents more than $100 million of personal capital committed alongside the issuance. This was also Ma's first open market purchase since Q4 2023, when he invested $50 million alongside $151 million as the stock traded below $80, which proved to be a timely investment. When the management team, which knows more about the business than anyone else, issues stock and then personally buys that same stock in the open market days later, it tells you everything you need to know about the returns they expect to generate on that capital. Which brings us to what capital is actually funding. Alibaba has now spent $28 billion of its $56 billion three-year cloud and AI CapEx commitment, putting it essentially halfway through the plan for a company that has historically been relatively CapEx light, averaging just under $6 billion of annual CapEx from 2000 to 2024. Sounds like an enormous number until you put it next to what the U.S. hyperscalers are committing in CapEx this year alone. Amazon just raised its 2026 CapEx guidance from $220 billion from $200 billion. Google now expects to spend $195 billion to $205 billion, up from $180 to $190. Microsoft is running at $175 billion on a lease-adjusted basis, or $190 billion unadjusted, while Meta expects to spend $137.5 billion. In fact, Alibaba's entire three-year commitment is roughly on par with what Amazon spent on CapEx in Q2 alone. However, there is a second distinction that, in our view, matters far more than the sheer difference in spending. Ask the U.S. hyperscalers what returns they're earning on this infrastructure, and you get plenty of qualitative answers. Demand exceeds supply, and the opportunity is generational. What they rarely provide are actual economics, a specific return on invested capital or payback period. Alibaba put concrete numbers around the economics on the call. Management estimates that current ROIC on AI infrastructure in the mid to high teens, with further improvement expected in the years ahead. Cash payback on servers equipped with AI chips is under 3 years today, falling towards 2.5 years or even as low as 2 years payback period as gross margins rise and Alibaba increasingly uses its own chips. With a 5-year useful life, that means at least 2 years of positive free cash flow after break even. In practice, these assets remain productive well beyond their accounting life, with management pointing to GPUs purchased in 2018 that are still running at full capacity. The reason Alibaba can be that specific rather than simply pointing to, quote, generational opportunity is the position it has spent years building across the AI stack. Alibaba is the only true full-stack player in China, with a platform spanning cloud infrastructure at 38.1% market share, the world's largest open-source model family in Qwen, and advanced proprietary silicon through Hedge. Rather than betting on which layer of the AI stack ultimately captures the value, Alibaba has invested to participate in all of them. More importantly, each layer feeds demand into others. That flywheel is already visible in today's results. Compute demand is running far ahead of what Alibaba can deploy, driving cloud revenue growth to 45% this quarter, with management guiding to growth above 50% next quarter and further acceleration ahead. AI-related products are driving growth, rising to 35% of external cloud revenue and expected to cross 50% within a year. Alibaba is then meeting that demand with its own silicon. T-Head's Zhenwu line now spans GPU, CPU storage, and networking chips serving more than 650 external customers with over 500,000 units already shipped. Every proprietary chip deployed is one that no longer has to be purchased from an overseas vendor, commanding 60 to 80% gross margins. That internal chip substitution, alongside the significantly higher margins of AI-related products, is a primary driver behind cloud segment adjusted EBITDA, rising 133% to $830 million this quarter, with margins expanded to 11.6% from 7.2% a year ago. Management is targeting 20% margins over the next 3 to 5 years, which still looks like early innings compared with peer AWS at 39% operating margins. Sitting on top of the hardware are the models, which pull demand back through the entire stack. The Qwen series has now been downloaded by more than 3 billion times globally in the past 6 months. Let me repeat that. The Qwen series has now been downloaded more than 3 billion times globally in the past 6 months, more than double China's population, while ranking among the world's top performers across multiple benchmarks. Every model downloaded, every agent deployed, and every token consumed drives incremental demand for compute, which runs on Alibaba's infrastructure and is powered by Alibaba's chips. That flywheel underpins Alibaba's long-term target of $100 billion in annual external cloud revenue, a near quintupling of fiscal year 26 levels against a total company market capitalization of just $265 billion today. They're giving it away. And keep in mind, we've gotten this far without discussing the core business that funds it all. Alibaba e-commerce group generated $30.34 billion of revenue, up 4% year on year, and $5.86 billion of adjusted EBITDA, roughly flat year over year. Holding profit stable is impressive on its own against China's weak consumption backdrop, but considerably more so given how much larger quick commerce has become in the mix. Quick commerce grew 45% during the quarter to $7.86 billion, with losses continuing to narrow and unit economics improving on higher average order values and greater fulfillment efficiency, while market share held throughout. Most importantly, management still expects quick commerce to deliver $140 billion of incremental annual gross merchandise volume by fiscal year 2028, with unit economics turning positive by the end of fiscal year 27 and profitability expected in fiscal year 29. Which brings us to what we think the market continues to underestimate. Alibaba is running two simultaneous major build-outs, one in cloud and AI infrastructure and another in quick commerce. Together, they have temporarily depressed near-term profits, driving the negative headlines each quarter and contributing to the 56.9% decline in EPS in fiscal year 26. What those headlines fail to capture is what the business tools on the other side, once the cloud and AI infrastructure has been built and monetized and quick commerce reaches scale and profitability. The earnings trajectory already points to that inflection. Consensus calls for 71.99% earnings growth in fiscal year 27, 39.92% in fiscal year 28, and 27.91% fiscal year 29, taking EPS to just under $12. That kind of growth is difficult to find anywhere in the world, let alone at just over 14 times earnings, which is why we continue to view Alibaba as the cheapest way to play AI globally and more than happy to look through the near-term earnings noise, etc. So we've highlighted all the key points from the earnings call, which you can find at hedgefundtips.com, and all the key points from the deck. And then you can go through the 12 points. Revenue came in at 9% up year on year. EBITDA fell, which we covered. Cloud services grew 45%. AI related product grew triple digits for the 12th quarter. Talk about the chip subsidiary. E-commerce revenue grew by 4%. Quick commerce grew by 45%. CapEx was up, which we discussed, and free cash flow we discussed. And then moving along, and you can read that all as well as the earnings call transcript and key points highlighted at hedgefundtips.com. Estee Lauder update. You definitely want to watch that interview on the Bloomberg channel at Yahoo at YouTube. For newer readers, here's a quick overview of the key drivers behind our thesis on Estee Lauder, a leader in global prestige beauty that is now inflecting back to full growth following a cyclical slowdown with meaningful operating leverage still to come. We love this. It's cooking off the double off the bottom, just getting started. And so on. So let's go through some of the key points. We've highlighted everything from the call for you to review, but we can't be here for 5 hours with all the stuff from the Money Show. Estee Lauder, the sales were up 6% year on year, ahead of consensus. Adjusted EPS beat on the bottom line, so beat on the top line, beat on the bottom line. Gross margin expanded 360 basis points to 75.5% from 71.9%. That's key. Adjusted operating income was up 95% year on year. Got the restructuring approvals. Net sales rose 12% reported in mainland China. That's a big part of their market. Americas delivered net sales of $995 million, up 6% year on year. Online organic sales grew double digits for the year. Full year operating cash flow increased 39% to $1.77 billion from $1.27 billion. And EL reiterated fiscal year 27 organic net sales growth of 3.5% while raising its adjusted operating margin outlook to 12.7 to 13.5, aka turnaround Tom strikes again. Estee Lauder is off the mat and going to the promised land and taking all of us with it. Amen. Hallelujah. Smiling so wide we could eat a banana sideways, or at least half a banana. We'll have the full banana by next year, I think. General market in greed mode. So, active investment managers, a little bit underweight, but that probably flips overnight when they report the new numbers. Transport's earnings estimates revision, top 30 stocks in the transport sector as earnings estimate revisions in the last 60 days. Revised up 4.8% for this year and up 3.81% for next year. Retail sector earnings estimates, top 30 weights in the sector. Last 60 days earnings revisions up for this year 4.63%, up for next year 1.82%. Most people would not guess that. One of the ones that's positive is which? It's called Etsy. Took their earnings estimates for this year from 565 to 594, for next year from 654 to 689. Amen, hallelujah. Turnaround Tom strikes again. Insider buying Alibaba Group, we covered that. More insider buying in Alibaba Group, we covered that. Key economic data for this week, not a ton there. Housing price index, consumer confidence, that's the CB consumer confidence, wasn't great. New home sales, again, weak, that's rates. What else we got? Core PCE in line with expectations, that was good. GDP quarter on quarter, Q2 1.5 in line with expectations. Durable good orders came in better than expected. PCE price was a little hot. Personal spending was better than expected. And retail consumer spending came in better than expected, 3.4% versus 0.5 last reading and 3.2% expectations. So that's positive. We'll probably start to see that in consumer discretionary in the next quarter's earnings. And that's that for right now. On to Thursday. Let's get to our incredible audience. Ask me anything questions for this week. Our first question comes from Landon Carlisle, Papa John's. We will cover that one in coming weeks. No change there. We've been adding stock selectively over time. And we covered that pretty extensively also last week. Tom, loved the podcast. Thoughts on tariff war with Canada and implications on CPS. Short-term noise. You answered your own question. Jason M. Blah, 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 blah. Okay, question about Papa John's. So answer that question there. Let's see. Manny is asking about Trade Desk. TTD. All right. This one I'm not a huge fan of. I've been asked pretty much every couple of weeks for the last year. We've continued to say no. It's continued to be the right call. I guess at some point it becomes attractive enough. I just think it's not yet. And even when this thing gets its first bounce, it's gonna take a while to build a base. So I think you got time there. I think on a fundamental basis, you're correct. On a just the amount of people that got taken out to woodshed, it's going to take time for this one to turn around. Portugal, give your take. This is Sebastio Pinheiro from Portugal. Hoping you could give your, I'm half Portuguese, so welcome to the call. CTS Eventum, second largest ticket seller after Live Nation. Let's see. CTS Eventum. All right, so the stock's down about 40%. Free cash flows declined. Revenues are up. Margins seem okay. I've never been a huge fan. I know of this type of business. I think you probably do okay with that, but it's simply kind of just a middleman, and a lot of these things have moats, so they can work, but it's not a business I would invest in. But on a pure fundamental basis, current fundamentals relative to price, you probably don't get hurt with this. It's just not the type of business that I love, or I can sleep like a baby, that governments are not going to come in and say, you have a monopoly, we're going to break you up. Let's see here. Return on capital, free cash flow. Everything looks good. I think you're okay here. It's just not my first pick. Justin Comerford, thanks for all you do. I shared your podcast with countless buddies. Thank you very much. Long-term listener. Attribute a lot of my skills to what I've learned from you. Curious on your take on Otis, a spin from United Tech. Yes, my friend, you are learning greatly, because this is on my radar. And I think you're 100% right on this one, by the way. I think you're 100% right on this one. So, it's going to be a little impaired as building slows, but I love it. Justin, good job. That's like the best AMA we've probably had in all year. Alex W. And I don't say that because we're doing work on it either. Alex W. Noops was a small business that started in a town called Best Hot Chocolate. Check out Noops. Tell me when you're coming to London. Okay, I will try that hot chocolate. Thank you for the recommendation. Marcel Bala. Opinion on Weinberger. Not advice. Opinion. And all of this, you got to do your own work. This is just me trying to get you started on the right foot or tell you don't waste your time. Weinberg. Oh, Wiener. What? Weinerberger. Weiner. All right. Weinerberger AG. What do we got here? $34. Price is down about a third. Free cash flow is down about a third. Shocking. Revenues have been down since 2022. Pretty flat. Share count flat. Debt going up. Multiple low. What do they do? Clay blocks. Fracking. Facing bricks. Roof tiles. Okay, so it's a building play in Europe. It's only down a third. I think it's okay. I just don't think you get an easy double or triple, but you could certainly make 50% over time as the cycle comes back. So not bad, but I think they're better IRRs in your future than that one. James J. Love your podcast. Watched weekly since 2022. Amen. Hallelujah. 4 years. I love that, James. Large run-ups after Moderna. I would be a buyer of Pfizer on that. He's asking, would you be a seller on Merck after that news? I don't really want to be selling healthcare, but I don't have a view on that one. I haven't done work on Merck, but I think your ancillary play that you can still get relatively cheap is Pfizer. Eduardo Gonzalez. Following your content since 2019. Amen. Hallelujah. Sarah, appreciation for all invaluable insights you share in your videos. Dedicated listener since 2019. Which is right around the time I started my investing journey. Incredible educational, foundational. Also proudly purchased some of your apparel and hats. Evaluating my portfolio strategies. A few questions regarding ProShares Ultra Pro Short SQQQ. I don't understand mechanics. Help my. Okay, Eduardo, here's the deal. Number one, thank you for 7 years of loyalty and support. You're the best. Number two, SQQQ. Stay away from leveraged ETFs because you erode over time. They're designed for day trading, and you'll see from time to time some of those things blow up on short-term moves, and they just shut them down. There was an SVXY that people made 20 bags on, and then in one day it dropped 90%, and Credit Suisse just shut it down, and people got zero. So stay away from them. In the short term, it's enticing because they work until they don't, but in the long term, you get taken out to the shed. Better ways to do it, not with that. If you need to do hedging, maybe you do some options, maybe you buy defensives, maybe you just build some cash, but I would not get explicitly short or long levered short ETFs under any circumstances. Nikolai Johnson, DXC, some insider buying. I've been looking at this one forever. And maybe it's time. DXC. You just got to convince me what the growth story is. I mean, share count's down, debt's down, multiple can't get any cheaper. It looks like a business in runoff. It had $21 billion in revenues in 2018. It's got $12 billion in revenues today. So they can just keep using that cash to buy in stock. But if they have no growth story, you're basically just buying an annuity and you're not going to get any price appreciation. So that said, what are they doing with the cash? There's no dividend. Information technology services and solutions, blah, blah, blah. Consulting and engineering, global infrastructure, software and services, software engineering. So again, software play, numbers are okay. I don't know. I mean, maybe your downside's protected. I just don't like the software and consulting plays with the exception of the highest quality. I don't think you're going to get hurt with it, so I don't hate it because we keep looking at it, but there's been nothing that makes us want to explicitly pull the trigger on it. I think what you'd have to do is go through the last 4 quarters of calls, maybe 8 quarters, find out what is the turnaround. What did they say the turnaround plan was for the last 6 years? And what have they said? What have they done? Is there a new jockey? Is there anything that's going to change the game here? Or is it just going to be a cash generative runoff business that with no growth prospects? My sense is they've either got someone new. Let's see, CEO of DXC. Raul Fernandez, he got in 2024. Stock's down 60%. So he hasn't been able to really turn it around. So find out what he's saying he's going to do and what he's actually done relative to that. And if there's any signs of hope, I think you got the financials to support it. But so far, not so good. Brian Hill, BFAM. Is this Brian Hill from Connecticut? Old golf buddy? Well, if it is, no, that's a different area code. All right, BFAM. I think we've looked at this one. Let's take a look. Early education, child care, comprehensive backup care, educational advisory, workforce solutions, I don't know what the hell it means, but the financials look okay. I don't think you're going to get hurt on this, so I think it's okay. I don't think I'd be rushing into that type of business, but I think you got a decent enough margin of safety. Lenny Hennessy, you know you like the healthcare sector. At present, believe it. With this in mind, what are your thoughts on HIMSS, specifically in relation to peptide approval? RFK peptide. I never make a bet on the basis of guessing what politicians are going to do, so I leave that gambling to others. I'm not a fan of HIMSS, to be honest with you. I think it's just crowded, and yeah, maybe they have a little bit of moat, but I just think there's a million, in Southern California, like everybody and their brother has a peptide business, and it's kind of just silly. So for that reason, it's not for me, or for one of the million reasons why it's not for me. DIY, we covered that. We'll do a comprehensive on Advance in coming weeks, but no change to thesis. That was a temporary softness, and not worried about that. Why is free Goose? We covered that. That's a timing issue, and you can go back to our article on Great Hill Cap on hedgefundtips.com about Canada Goose. Mentioned dividend payers. Turnaround situations. That's fine. That's what you want them to do. You want them to conserve cash, implement the turnaround, and then they'll start to pay dividends again. Ryan Long. It's the right time for them to issue that $10 billion. We covered that. Kyle Meacham. Can you please share your approach on how you add to position that have drops on earnings releases? Do you try to bottom tick day one? No, usually a few days or a few weeks. I'm not trying to bottom tick anything. I never do. So case when they do not have major drops. Earnings guidance. Yeah, no, we're buyers of both Advanced Auto Parts and VFC, if that's your question. Yeah, I mean, like, we're just going through accounts this week, anywhere there's cash from dividends, we're just buying VF, buying Advance, buying a little Goose. You know, we were buying BABA when it was lower. Robert Smith, look at ACN. It's a consulting business. I don't love the CEO came on talking about the weather or some BS excuse in the last quarter. Historically, it's been a great business. AI is going to have some impact on it. Probably got overstated, but after a 50% bounce off the lows, I don't chase up there. If it's not the type of business we invest in, but so the answer is no view on that one. Sorry. William Kerberger, looks like he's from Germany. Zumtobel Group, ZAG. Free cash flow has been in pretty steady decline. They've been buying in shares. There's just no sign of revenue improvement. I mean, they're 1.2 down to 1.04. They were 1.36 10 years ago. So what are they doing? Selling horses and buggies? Why can't they grow with GDP? Lighting industry worldwide, lighting and components, luminaries, indoor outdoor lighting, turnkey solutions. What is this, like a Swiss company? Yeah, it sounds like they got competed away. What's happened to the margins? 36%. How they've been able to retain margins with revenues go down is a little surprising. I guess worth a little bit of work, but I mean, they're not going out of business. But you know what you got to do on this one? Get on the last 8 or 12 calls. What is the turnaround plan? What are they doing to fix this decline in revenue? If you can get some level of comfort on anything happening with green shoots like we have with VF Corp every quarter, things are turning, then maybe there's something to do here. But until you get some clarity on that or a new jockey with credibility, I think there are better uses. Wells Fargo is from Vivek. Wells Fargo downgraded Goose. Must be a buy signal. Probably. Bob A. How much of your share price is rooted in DCF, multiples, comps, or simply more holistic market views? We do all of it, Bob. I mean, I love Charlie Munger explained Warren Buffett the best. He goes, Warren Buffett always talks about DCF valuations. And in all the years I've been working with Warren, I've never seen him once do a DCF or a spreadsheet on a DCF. And because your estimates are guesses, but the longer a business has been in business and the more stable the growth is, which is the type of businesses that we trend towards, the more predictable the out years are, and you can understand whether price dislocation is permanent or temporary when you know the business. So the answer is you got to do it all. I mean, that's the answer, Bob. And each situation, the only way you can get through which things you apply more weight to based on industry, based on company, based on experience is seeing how many of these have operated through many different cycles and understanding what works in one area doesn't necessarily work in another. And that's just experience. There's no shortcut. Josh B., could you take a look at Maxion Wheels? MYK. Oh, there it is. Brazil. Yeah, I would like to get some Brazil exposure. Stock's been just muddling around for 20 years. Revenues are up. Cash flow just turned positive. Share count, they've added 50% shares. What do they do? Automotive wheels and structural components in Brazil. Yeah. I mean, the South Americans are allowing the Chinese to flood their market, so I'm not sure how much their aftermarket stuff is going to be useful. I don't think this is a great use of capital. I mean, and I can't, with $3 billion of debt, 300 billion real, and 319 million of free cash flow just now turning positive with not great growth prospects, I think there are higher and better uses. It's not to say that stock price won't go up. I just, I wouldn't be there first. Okay, so he's talking about UPS. I agree with UPS. We have discussed UPS. I'm just waiting for them to replace the CEO. Next, Leela Gaskins. Yelp. Not interested in that one. But I'll take a quick look again. Yeah, I see. I mean, I definitely see what you're trying to do here. It looks like a trade. And a trade that will probably work. Margins have been, I see what you're talking about here. I think you could take it for a trade. I don't think you're going to get hurt. It's not my first choice, but decent look. So why not? WVVI, Vineyards, hard pass. Just because something has a good product per se doesn't mean it's a good business, and certainly doesn't mean it should be public. And yeah, I don't want to buy this type of business. I mean, it's so crowded, and it's like, no, not for me. Bob S. Donut, which is what, Krispy Kreme. This thing has been a dumpster fire. Again, this is another example of good product does not equal good company or good stock. So I would be inclined. Turning free cash flow positive. Revenues continue to decline. Their McDonald's partnership collapsed. It's a trade at best. This is not a business I want to own forever. MLCO, yeah, the Chinese casino company. I'd rather play BABA for recovery of the Chinese consumer, but because you have more outs. This you're just talking about casinos. I think it's not terrible. What's the debt though? $6 billion of debt, 495 million. You got a little bit of a leverage problem, but I think you could get a punt on this, but it wouldn't be my first choice. Tommy G, Goodyear Tire. No, the Koreans killed these guys and they've been left for dead. We've covered it literally every other week for the last 2 years. People keep sending it in and it keeps not working. So maybe now's the time. It's cheap enough, but it's kind of a dead deal here. I think it's a trade. I wouldn't want to own this business. Andrew H, FLO. I think we've covered Flower Foods. $2 billion of debt. 295 million of free cash flow. Margins seem okay. What are the brands in this one again? Get a dividend, 7%. Cakes, cookies, crackers, Bakehouse, Simple Mills, Wonder, Tasty Cake. Okay, 1919. I think it warrants some more work. I think it's kind of interesting. I see what you see. I don't love the space particularly. We'd rather play Hormel with the higher protein stuff, but at a price, this gets interesting. So good work there. Worth doing work on, not necessarily guaranteed to take action, but okay. I like how you got there. Good job. Can tell you're a long-time listener, first-time caller. Maybe not first-time caller. Lee, what is this? A Chinese automaker? Yeah. Yeah, hard pass. Too crowded. Negative free cash flow. Luke Travers. Any good sell side guys out there, or are they all full of shit salesmen? There are some good sell side guys. Hartnett is good. Michael Hartnett over at Bank of America, really good. Sam Zars. What do you think about normalizing EBITDA? EBITDA is a bullshit metric. I'd be normalizing cash flow. Goose is fine. It's a small position. It'll probably get bigger if the price stays down. Leverage play on the Chinese recovery, and we're okay with that one. BMWKY. You know, it's not like something like Baba in our heyday and PayPal now, where we have massive amounts of money in it, and it's super duper high conviction. It's like, it's got multi-bagger upside, with some risk, and it's sized accordingly. But we're comfortable with that position. Jasper J, BMWKY. Negative free cash flow, revenues declining, share count's coming down. Debt's up. Is that legit? $101 billion of debt? Oh, BMW. No, we don't buy auto producers, Jasper. Welcome to the podcast. We cover that every week when people send me in Stellantis and all these others because they look cheap. We buy the picks and shovels, not the speculators. That it's just a terrible business. Sarah Owens. Yeah, advanced we're fine with. We're buying on weakness. William North. Builder. BLDR. I think we've looked at this one. I'd probably agree with you here. So there's been no sign of an inflection in free cash flow or in revenues. If we're going to play home building, we want to bet all day long with Brad Jacobs. No one is better. Why would you screw around with this when you could buy Brad Jacobs roll up of QXO? So the answer to your question is it probably works when housing recovers, but with Brad Jacobs, even if housing didn't recover, he's going to find a way to make money. With these guys, it's just a levered play on the housing recovery, which I think will work, but I think your highest and best use is QXO, which we own. Dwayne D. Universal Music Group, no, not interested. Never liked it. Not for me. UMG. And I'm sure the numbers still look good as they did for all the years that I also wasn't interested. So, Music Group. Man, I get it. I just don't love the business, but I definitely get what you're talking about here. Maybe. Maybe. We'll do more work. Dwayne, I know I'm not going to take action on this, but I understand why you think it's worth looking at, and I have to agree with you. It's worth looking at, not necessarily doing anything about. Adam, take a look at WGO, Winnebago. This again is going to be, part demographic tailwind, part's going to be rates. Yeah, maybe you can get a double off of this, but I don't think it's a great use of capital right now. There's no sign of turnaround. Camping World, I think, is like teetering. I don't know, but their numbers got really bad. Their revenues are cut in half. Cash flow is starting to turn. So you got to, on this type of thing, there's so many of these leisure brands, Polaris, We've looked at a bunch of them. We keep saying no. I mean, listen to the last 8 quarters, see what they said they're going to do about the turnaround. It's really going to be a function of rates and demographics for that. It's older people. But it's an area that we tend to stay away from, and we have done well by doing that. So, because we've seen people getting taken out to the woodshed. And that's that. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.